Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we would be discussing Index 103 on business combination for your CA Final FR in full detail along with the important questions for this chapter. So if such type of content does help you, please do like, share and subscribe. Press the like button now, it would really mean a lot to us. So let us get started. We will go to the business combination chapter under Index 103. A tier 1 category topic and comprising of various important concepts and also serves as a base for your consolidation. So the first part of the chapter contains a lot of theory containing what is business, what is control, what are the steps, etc. And then you have the detailed numerical questions at the latter part of the chapter, including smaller numericals for items like PC net assets, which together is relatively important. So over here we'll discuss everything, the theory and also the important numerical steps. So let us get started. So over here, first of all, what is business combination? It is a transaction whereby we acquire control over a business. Now, what is a business? Well, business is essentially an integrated set of inputs and substantive processes which is capable of generating an output. An output can be products, goods, services, investment income, etc. So there are three essential features of a business. When we see there is inputs, can be something like assets, materials, etc. that you use. Substantive processes, which is usually made up of organized workforce, skilled manpower, etc. along with, let's say, documented or substantive critical processes. And third is the ability to generate output. So it is possible that you may not actually have an output, like you might be a startup, but if you have the ability to generate output, that is also sufficient. So that is treated to be a business in general. And second is control. Now control comes from the ability to direct. It comes from power, which comes from the ability to direct the relevant activities, which gives us exposure to variable return and a linkage between power and variable return. So there are a lot of moving parts in these definitions. So if we kind of quickly go through what is meant by business in a much more detailed manner. So for assessing a business, Index 103 says that you can test initially for something called as a concentration test, which is optional. So under the concentration test, you will see whether all the amount that you are kind of acquiring, is it concentrated in a single asset. So what do? You try to find the gross assets taken over. There's a special formula for this. This is PC plus NCI plus liabilities minus your cash and deferred tax adjustment. So that will give you the gross assets, and if substantially all of the value of the gross assets taken over is concentrated in a single asset, maybe you are acquiring building and almost all of the value of the gross assets taken over is concentrated in the building, then we say that this is an asset purchase. There is no need to do any further assessment. However, if the concentration test fails, so substantially all, that is less than 90%, so if you cover less than 90% a single asset, then we say that, well, it is not an asset purchase necessarily. Does it mean it is a business purchase? The answer is no. You will still have to further assess for a business. So when you sit to further assess for a business, you can figure out whether this business has some existing output or it does not have existing output. If it does not have existing output, then there is a necessary condition that you should take over the assets and liabilities, that is the inputs, along with the organized workforce. If you take it over along with the organized workforce, that is critical processes are also taken over, then we say that this is a business. Otherwise, if you just take over the assets without the organized workforce, it will be an asset purchase. Similarly, if you have an existing output, like the company has products, even over here, if you are taking over just the assets without the organized workforce or critical processes, it may still be an asset purchase. However, there is also one more condition over here, only in case where there is an existing output, that even if your workforce is not taken over, if your assets, processes are so unique and scarce that they are difficult to replicate, like you have a global presence, some unique processes and technologies, in which case this can still be constituted as a business. So this is a lot of theory. Usually the institute does not test you as often for that, but if it does, you should be aware of. So if you were to quickly round up, when you look at assessment for a business, we first see if we want to apply concentration test. Remember, it is optional. So even if you don't apply concentration test, that's fine. Institute does not apply it unless it is specifically given. So you can directly go on the assessment of business. If you assess for business, you see whether there's existing output or no existing output. If there is no existing output, then you need to take over assets along with the organized workforce. That same condition is also there for existing output, that you need to take over assets along with the organized workforce. However, if you decide not to take over the workforce, then your processes should be so unique or scarce that they are difficult to replicate. If one of these two conditions are fulfilled, then it is a business. Otherwise, even over here, there's an asset purchase. Essentially, the underlying item behind business is there should be inputs along with substantive processes that are taken over, which gives you the ability to generate output. And these processes over here should be substantive, crucial, critical processes, and not ancillary or incidental processes. So that is regarding business. Again, there is some guidance regarding concentration test as well. And then you go to control. For a business combination, there should be control over a business that you are acquiring. Control as per the older law was always supposed to be greater than a 50% stake in the paid up share capital. However, under IND AS, they don't associate it with a stake. However, they say that control should give you power, unilateral, not joint, not shared, unilateral power, which gives you the ability to direct, not just significant influence, direct the relevant activities, the current ability to direct relevant activities. Now, this is very important. Usually, this power comes from shareholding, and if you have more than 50% shareholding, you get the power. But that is not necessary. Even if you have less than a 50% shareholding, let's say 45% shareholding, and the remaining shares are widely dispersed, even then, let's say thousands of shareholders, then even with that 45% shareholding, you have a sufficiently strong block whereby you can exercise power, which gives you control. Similarly, there might be certain cases where you don't necessarily own more than 50% stake. You own, let us say, 20-30% stake, but for the remaining, you might have options to buy the other, let's say, stake, 30-40% stake. So should these options be considered while assessing control? The answer is, well, it depends if these options are substantive. Substantive means there should be a practical ability to exercise. It is not just an option on paper where the exercise price is, let us say, 5 times the market price. Or it is just not just an option on paper where if you exercise the option, all the critical, crucial key management team might leave. In which case, the option is not substantive. There is no practical ability to exercise, in which case there is no power, we can say, that the options give you. However, if the options are substantive, that is, there is a practical ability to exercise, like if the exercise price is lower than the market price, or if you acquire, you can get some synergy benefits, in which case the options are substantive and you can take them in the assessment of control as well. Along with the current ability to direct relevant activities are those activities which significantly affect the return. You should also have an exposure to variable returns. Like a lender, for example, does not have exposure to variable returns, and hence a lender cannot be ever said to have control over an entity. However, if you are a regular shareholder, you do have exposure to variable returns, can be positive, can be negative, and hence you are considered to have exposure to that variable returns. And then lastly, there should be a linkage between a power and the variable return, like you should be getting that power from as a principal, as a shareholder, and not a derived power, like you are a CEO who has been appointed by the shareholders. That power is derived, not as a principal. So for you to showcase control, there has to be an ability to direct the relevant activities, exposure to variable returns, and a linkage between power and variable returns. So when is there a practical ability, etc., we have discussed over here. Also, the rights have to be substantive. That is, there should be a practical ability to exercise these rights. Protective rights, one needs to remember, needs to be ignored. So rights which just can protect a particular holder and they don't give any ability to direct activities should be ignored. So this is regarding business and control. Business combination refers to an act where you acquire control over a business. So these transactions should ideally be covered under 103. However, there are two distinct scope exclusions over here. First, if a transaction results in you getting what we call as joint control, that is a joint ability to direct relevant activities, in which case IND AS 111 on joint arrangements will apply and not 103, and hence there is a scope exclusion for joint ventures where you have joint control. And second is if there's a pure asset purchase, in which case obviously business combination will not apply, then the respective standards will apply, like a respective standard like IND AS 16 for PP, IND AS 38 for intangibles, IND AS 109 for financial instruments, etc. So what is the distinctive difference between these two? Well, if you follow asset purchase, in most of the standards, initial recognition happens at cost, like PP, intangibles, investment property, etc. Initial recognition happens at cost, whereas in business purchase, it happens at fair value. Next, at the time of asset purchase, you never create a goodwill. However, for business purchase, there can be a possible goodwill or a gain on bargain purchase. And third is transaction cost. For asset purchase, usually the directly attributable cost for acquiring a PP, intangible, etc. is capitalized. However, for a business purchase, acquisition costs are expensed to the profit and loss account. So these are the three distinctive points of differences. Then before we go into the accounting, there are certain illustrations of business combinations which can apply maybe in SFS or CFS. Remember, if nothing is going, we are doing accounting in the CFS. So in certain cases of business combination, you might have a business combination even applying in the SFS. Like for example, there's an amalgamation or there is an absorption. Then even in the SFS, you will take over the assets and liabilities. However, when you look at a holding subsidiary relationship in the SFS, this is to be shown like Tata Motors acquires a stake in JLR, 100% stake. In the SFS of Tata Motors, this will merely be shown as investment in JLR. However, when you prepare consolidated financial statements, which is mandatory if there is a subsidiary, then this will be treated as a business combination whereby Tata Motors in its CFS will take over all assets, all liabilities of JLR, and hence the business combination accounting for such holding subsidiary transactions will apply in CFS. So in SFS, well, a separate Ind AS 27 will apply whereby you are given a choice for investments in subsidiaries, associates or joint ventures in the SFS where they can be shown at cost, or you can follow Ind AS 109, that is FVTPL or FVOCI. If nothing is given, Institute always assumes that in the SFS these investments do appear at cost. Okay. Next, you go to the acquisition accounting. Within acquisition accounting, under Ind AS 103, for an actual business combination where you acquire control over someone else's business, there are 6 distinctive steps. First, identify the acquirer. Acquirer is typically the person who acquires control over the selling company. Students tend to believe that this is the person who pays the PC. May not necessarily be the case. The person who acquires control is treated to be the acquirer. Second is the acquisition date. Acquisition date is a date when control is obtained. Remember, there can be various dates given, the date when negotiations are happening, etc. All of these dates are irrelevant. The date when you obtain the ability to direct the relevant activities is the relevant date. Step number 2, acquisition date. Step 3 is the purchase consideration, which is a payment made to the owners of the selling company, not necessarily the shareholders, owners. Whoever is classified within the equity of the selling company will be taken as PC. Fourth, taking over net assets. 100% of net assets will be taken over even if you are owning, let us say, an 80% stake, because you have the ability to direct the entire net assets. So these will be taken over at fair value. Step number 4, net assets taken over. Step number 5, non-controlling interest, because you're taking over 100% of net assets. However, 20% is attributable to someone else. So you create what is called as a non-controlling interest. And 6, after considering all of these, you do calculate the goodwill by PC plus NCI minus net assets will give you goodwill. So these are the 6 steps of acquisition accounting, which is fairly important from an exam perspective. Especially steps 3, 4, 5, 6 are more important. So we'll quickly discuss for each of these steps. Step number 1 involves identifying the acquirer. Acquirer is a person, as we said, who obtains control post the acquisition. Typically, one can say that this is a person who pays the PC. However, there can be certain cases of reverse acquisition. And in cases of reverse acquisition, it might happen that whoever is paying the PC, that is a legal acquirer, may not necessarily obtain control post the acquisition. And hence, in such a case, the legal acquirer who is paying the PC actually from an accounting perspective becomes a target or an acquiree. And the legal subsidiary or the target or the acquiree can become the accounting acquirer. When can this happen? Well, various cases where it is possible that in the post-combination entity, the shareholders of the so-called legal selling company are becoming controlling shareholders. So generally this can happen if a smaller company tries to acquire a larger company by issuing its own shares, in which case what will happen is post the transaction, the shareholders of the so-called legal selling company will get more than a 50% stake in the post-combination entity, and hence they will continue to control their old business, but they will also obtain control of the business of the legal acquirer. Such transactions are called as reverse acquisitions, which need to be checked for carefully. Institute sometimes gives you hints for detecting whether there's a reverse acquisition. It might say that there is a larger company which takes over a smaller company. A smaller company which is acquiring a larger company by issuing shares, or the management of the smaller company continues to control the post-combination entity. So these are soft indicators which can probably help you in actually sitting and calculating whether the stake post-combination continues to be controlled by the acquiring company shareholders or it is shifting to the other company. So we have given an example over here for which a separate sum also we will try to discuss, and there's a separate video on reverse acquisition which you can refer. A detailed video on this topic is also there. Okay, so that is the only challenge that can come in identifying the acquirer. Then is acquisition date. Acquisition date is a date when control is obtained. Now there might be different dates, like you might give an offer, negotiations may be happening, shareholders may give approval, PC may be paid. Generally, if nothing is given, the closing date. Closing date is a date when let us say you obtain shares of the selling company and you can now vote and get the ability to direct activities. That should be the date when control is obtained. All the other dates are actually noise. However, sometimes the parties may mutually agree to an earlier or later date. If they agree to an earlier or later date when actual control, that is representation on the board, etc., passes, that is when we will say that that agreed date mutually can be the date which is the acquisition date. Certain times your acquisition may be subjected to regulatory approval, and if regulatory approval is substantive, that is a regulator has the ability to cancel the merger as well, in which case you cannot say that your acquisition date is a date before the regulatory approval is obtained. It is only the date which is mutually agreed or the date when the regulator gives approval, whichever is later, which will be the acquisition date. Sometimes it might happen that you might obtain control, that is the ability to direct, from 1st March. However, you have determined the PC based on the net assets on 31st December, or you have said that post 31st December, whatever is the profit will be attributable to the acquirer. Remember, control is not when you start earning profits. Control is the day when you get the ability to direct the relevant activities, and hence control will be obtained from 1st March. That is the date when you get the ability to direct the relevant activities, irrespective of every other date. Okay. Another interesting case over here that can possibly arise is a step-up acquisition where you acquire stake in steps. Let's say you acquire 10% stake on 1st April 12. Does that give you control? No. Another 15% stake on 1st April 13. Does that give you control? No. You still have 25% stake. And then you acquire another 30% stake. That means you have a total of 25 plus 30, that is 55% stake on 1st April 2014, as you can see over here, in which particular case we will say that this is the date when control is obtained. This is a date. There may be 4 dates when shares are purchased, but business combination is not the date when shares are purchased. It is the date when control is obtained, and control is obtained, let us say, on 1st April 14, and that is the date when Ind AS 103 will apply. Beyond that, you might acquire another 10% stake, but that is an additional stake purchase post control, in which case you will do the separate guidance under consolidation for this. So 103 will apply on 1st of April 2014. That is the date when control is obtained with the 55% stake. Now there is some guidance practically regarding a concept of appointed date. However, from a student standpoint and exam perspective, at least the institute has not incorporated that, and almost every sum that we see for the institute, they always ignore the appointed date, which may be a date which may be mutually, let's say, decided by a court scheme or something, but they look at the date when control is obtained. So at least from an exam perspective, your date would be the date when actual ability to direct relevant activities are transferred. So this is your step number 2. Both of these, I would say, are not as important from an overall exam perspective. Then you dive into the most important parts of this topic, which is determination of purchase consideration. PC is determined as payment made to the owners of the selling company. Owners can be equity shareholders. Owners can be ESOP holders as well, because SBP reserve is classified within a part of equity. However, if preference shareholders are shown as a part of liabilities, they are not owners. They are similar to debentures, in which case payment made to preference shareholders may not necessarily be a part of PC. And hence PC is a payment made to owners. PC can be discharged in cash. It can be discharged through entities' own shares, debentures, etc. These shares or debentures, you will take the fair value of these shares or debentures that is issued. Similarly, sometimes you might end up paying PC in the form of non-cash assets, let us say like land. In such a case, again, your PC would be based on the fair value of the land which is paid. If that land is currently being shown in the books at a particular value, you will remeasure the land, take it up to the fair value, and then take it as a part of PC. So PC will be the fair value of shares issued, debentures issued, non-cash consideration like land paid or cash paid. All of this will be a part of PC. Additionally, there are 4 unique items I would say, which should be considered. First, there is something called as deferred consideration. Sometimes what might happen is, you might be paying cash of 90 rupees today, and you might agree that along with that you will pay another 30 rupees to the shareholders of the selling company, let us say after 2 years. So technically, what are you paying to the owners of the selling company? Well, 90 plus another 30. But are you paying the 30 now? No, you are paying it after 2 years. In which case, should it be a part of PC? Well, yes, because this is payment made to the owners of the selling company, and hence it should be a part of PC. But at the same time, at what value should it be a part? Well, we said that this will be at the present value, because 30 after 2 years is not equivalent to 30 today, and as a result, you might try to find a present value which may be, let us say, 25, in which case your PC would be 90 of immediate cash paid plus the present value of deferred consideration, which will be, let us say, 25, and hence your PC may be, for example, 115. What will you do with the deferred consideration? Well, for subsequent accounting, deferred consideration is a financial liability since there is a contractual obligation, let us say in this case, to deliver cash. However, Is this one of these items which will be accounted for using FVTPL? No. For FVTPL, there are stated items. Deferred consideration is not one of them, and hence you will account for this using amortized cost method. And then in each year, whenever you record, let us say something like unwinding, this will be interest which will be taken as finance cost in the P&L. So this is deferred consideration initially to be taken over as a part of PC at the present value. For subsequent working, this will be recorded at amortized cost principles. Second is contingent consideration. Now this is something which I would rate as important because institute really likes asking questions on contingent consideration. Should this be a part of PC? Well, yes, maybe the consideration which is payable to the owners of the selling company after 2 or 3 years is linked to the entities achieving, let us say, a particular level of profits, user base, etc. So there is a contingency involved. If there's a contingency involved, should this still be a part of PC? Answer is yes. The standard says you will take it over at fair values. You will record contingent consideration at initial recognition, no matter how you classify it. You classify it as equity, you classify it as liability, you say it is probable, not probable, all of these would not matter. You will take it over at fair values. Now, how do you calculate fair values? One of the two methods, like you study in IND 115, you can take the probability based weighted average, that is the expected value method, or you can take the most likely outcome, where you can select the most likely outcome, and based on this most likely outcome you can try to find, let us say, your fair value. Generally fair value is given. If not, you can calculate it based on the data available in the question. So whatever is the fair value at initial recognition should very well be a part of PC, irrespective of how you classify it, at least for initial recognition. Why? Because this is again payment made to the owners of the selling company, and considering the facts and circumstances now, this is the fair value of this consideration, and hence it should be a part of PC. But for subsequent accounting, you have to see the nature. So is there a contractual obligation to deliver cash? If there's a contractual obligation to deliver cash, yes, maybe there are certain limits given, but if there's a contractual obligation to deliver cash, it is a financial liability, and being a financial liability, which is a contingent consideration, as per IND 109, you will account it as per FVTPL subsequently. So any fair value gains or loss subsequently will go to the P&L. There will be no amortized cost working because we don't know that ultimately what will be the contingent payment, and hence you can't amortize it up to a particular redemption value. However, what if the contingent payments are to be made in shares? For this, you have to see that will the payment, if the payment happens, so is the settlement may happen in entities' own equity instruments for a fixed number of entities' own equity instruments. So if it is given that if the profits crosses, let's say 10 crores over the next 2 years, then we will have to issue 2 crore more shares. So here the settlement may happen, that is if the profits cross a particular level. But if it does happen, it happens for a fixed number of shares, in which case this will be an equity item, and equity items cannot be remeasured as per IND 109, and hence it will be recorded at the value at initial recognition only. Subsequently, it is very much possible that the values change, but we will ignore that because equity cannot be remeasured. However, if the settlement may happen for a variable number of shares, you might issue 2 crore shares, 3 crore shares, 5 crore shares. If the settlement may happen for a variable number of entities' own equity instruments, it is still a financial liability for which FVTPL accounting will apply. So contingent consideration at initial recognition, you will measure it at fair value, and it should be a part of PC irrespective of the classification. Subsequent accounting depends on the classification as per IND 109. If it is a financial liability, that is obligation to deliver cash, or settlement in a variable number of entities' own equity instruments, then your workings will be as per FVTPL. If it is equity, then your workings will be based on the value determined at initial recognition. So this is regarding contingent consideration. Next is another important point, that is a fair value of pre-combination element in case of what we call as replacement awards. Now what happens in case of ESOPs? It is very much possible that ESOPs, that is SBP reserve in the books of the selling company. Now like you pay PC, when you pay PC, you pay to the owners, that is the shareholders of the selling company. Maybe for acquiring those shares, you might give your own shares as well. So is that a part of PC? Yes. In a similar way to the employees of the selling company who have existing ESOPs, you might take over those ESOPs and in return give them options to buy shares in your company. So Tata Motors and JLR might have an ESOP scheme. Tata Motors may take over that ESOP scheme and replace it by shares of Tata Motors instead of shares of JLR. Now this is called as replacement award. Now generally, as a part of PC, we will always take the fair value of the consideration paid. Generally for the owners, you are paying consideration purely and squarely for the purpose of acquisition of business. But in case of an ESOP, if let us say the vesting period is 5 years, out of which 2 years have gone by, 3 years are still remaining, the total fair value of the replacement award is towards the employee rendering service. out of 5 years, if the employee has already rendered 2 years of service, he's not going to further render any service to you. So by virtue of the 2 years of service which he or she has rendered, he becomes kind of an owner of the selling company, but he still has to render 3 more years of service. And hence, the entire fair value cannot be attributed to the business combination. You can say that, okay, if you are giving options which are, let us say, worth 90, or the fair value of these options which are being acquired are, let us say, 90, maybe 2 by 5, that is, let us say, around 38 if I'm not wrong, would be attributable, 38 or 36, whatever it is attributable to the fact that you already rendered service, and hence I'm paying you this. But for the remaining, let us say, 54 rupees or so, you will have to slog and work for the acquirer for the next 3 years. And hence, to say that the entire 90 is paid because you are owner of the selling company, no. A part of 90 is because you are owner, a part of it is because you are going to render service in the future. So the standard over here says that you will have to segregate the fair value of the replacement awards into pre-combination element and post-combination element. So how do you segregate? Well, the pre-combination element will be taken as a part of PC. Let me just see. Okay, the pre-combination element, let us say, will be a part of PC. Why? Because this is a payment made for service already rendered. And hence, this is payment because you are kind of an owner in the selling company by virtue of already rendering service. So how do you find the pre-combination element? You will take the fair value of the original awards. So it is possible that the fair value of JLR's individual awards, for example, the fair value of JLR's individual awards were, let us say, 75 rupees as on the acquisition date. So ideally, I should give them new awards worth 75. However, Tata Motors replaces it and gives them, let us say, at 90 rupees. Now, let us say this awards had a vesting period total of 5 years, out of which 2 years are already served, 3 years are remaining. Now, how will you allocate these values between pre and post combination element? Remember, the pre combination element is for service already rendered. By virtue of it, they become owners and hence is a part of PC. The post combination will be employee cost, which will be recorded over the service period. So how much of this will be attributable to pre combination element? So we'll say, okay, the fair value of replacement awards in total is 90 rupees, but out of this 90, we can say that the additional 15 between 75 and 90 is arising due to modification, because due to the replacement of the plant today, and hence this additional 15 you are probably paying because you want the employees to continue in service in the future years, and hence no part of this 15 should actually go to the pre-combination element. So when you calculate the pre-combination element, the standard says you'll have to do it based on 75, that is the fair value of the original award, and to the fair value of the original award you will multiply this with the vesting period served, which is 2, upon technically the longer of the original vesting period, that is 5 years, or revised vesting period. So let us say you revise the vesting period, you say 2 years are served, ideally you have to remain for the remaining 3 years. Instead, let us say you can continue for 2 years only. So your revised vesting period is 4 years. So for finding the pre-combination element, you will take the fair value of the original award, that is 75, into the vesting period served upon the longer of 5 and 4, that is 5, and hence this will come to probably 30 rupees. This 30 rupees will be taken as a part of PC. The remaining, let us say 90 minus 30, so that comes to, let us say, 60 rupees, is linked to the fact that employee has to render service in the future years, and hence this will be recorded as remuneration cost as and when employee renders service. No effect in PC today because that is linked to future service, not linked to the fact that you are owner as of today. Not a part of net assets because there is no liability today till the time you render the future service, and hence this will be treated as remuneration cost as per IND AS 102 to be recorded as and when service is rendered in the future. No effect as of this today. You can just show this working and you can spread this over, let us say, the remaining 2 years. EB account debit, let us say, to SBP reserve. Till that time, in your SBP reserve, you can include 30 as a part of PC because this is kind of a payment made to the owners. Okay, so this will give you kind of the total PC over here. Now, this is a workable PC provided you acquire stake in a single transaction, control over a single transaction. However, what if you had existing stake, like you, for example, had 30% stake? Did that give you control? No, but that is significant influence. Probably you account it as an associate as per the equity method. And later you acquire another 70% stake. Does that 70% stake give you control? Well, yes. So if the 70% stake gives you control. That is the date when control is acquired, acquisition date, in which case obviously the PC that you pay for that 70% stake is definitely a part of PC. But what about the 30% stake? You might have acquired it a few years back. So the standard says that for the purpose of goodwill calculation, every number as on the acquisition date should be at fair value. Net assets are at fair value, 70% consideration that you are paying at fair value. However, for the 30% stake, we don't know at what value they are. Maybe you are showing them at cost only. Maybe fair value was not determinable, or you are accounting for them using the equity method as per IND 28, or you might have even shown them at fair value. I mean, we don't know. The standard says that no matter what you have done as in the past, as of the date of acquisition, you have to ensure that this existing investment should be remeasured and shown at fair value and taken as a part of PC. If it is already at fair value, you don't need to take any further action. But if it is not at fair value, you will have to ensure that you remeasure this existing investment, take it up to the fair value. Sir, but where will the difference go? Let us say your investment is appearing at 7,000. Today the fair value is 8,000. Okay, so you will remeasure it to 8,000. Investment account debit 1,000, and the difference will go where? Well, it depends. If let us say this investment was classified as FVTPL, then the 1,000 should go to PNL. If it was classified as FVOCI, then it should go to the other comprehensive income, fair value reserve. And if it was, let us say, shown using the equity method of IND 28 or some other base, then that, if in absence of information, it will be taken to the profit and loss account. So your investment has to be remeasured, existing investment has to be remeasured, taken up to fair value. If it is already remeasured, no further action. If not, you remeasure it, take it to fair value. Difference in ME, if any, you will account it as per the respective standard, as per its initial classification, and then as a part of PC, you will take over the existing investment also at fair value. So long story short, if you go to this is for existing investment before control is obtained. You'll have to remeasure the investment. As you see, existing investment should be as a part of PC at its fair value. You will remeasure it and then take it as a part of PC. Okay, so there's a small example also pertaining to this, and we'll do a problem also in our questions where we kind of do this working. So step 4 is net assets taken over. We will do that over here, but before that we also discuss the NCI. But let us say we first discuss what is to be done with the net assets as well, and then come back to the NCI. So over here, when you look at the net assets taken over, a few crucial points that you need to remember. First, will you take over only assets to the extent of your stake or 100%? No, we will take over 100% of the net assets, irrespective of the 70, 80, 90% stake you have, because you have the ability to direct the entire 100%. And hence is the birth of NCI. Because you have only 70% stake, you are acquiring 100% of the assets, so you have to give 30% of them to the NCI. Had you consolidated only 70% of the assets, then out of that 70%, no one else has any other share. But out of 100, 30 is attributable to NCI. So you have to take over assets and liabilities at fair value. On the acquisition date, 100% of them. Again, you take them over at fair values. If fair values are not given, then you assume that the balance sheet value is equal to the fair value. But if it is given, you will take it over at fair value, because you are acquiring control over someone else's business. If they have to transfer you the assets, they will charge the fair value for that. You will take over assets, you will take over liabilities, but will you take over the reserves, other equity balances? The answer is no. Remember, reserves in general are not transferable items. Assets and liabilities are transferable. These reserves were earned by the shareholders of the selling company, for which you are paying the PC. You have not earned them. You are kind of buying the company. Reserves post-acquisition, when you study the consolidation chapter, will be allowed to be consolidated to the extent of your share. But reserves pre-acquisition, well, no. You cannot take over the other equity balances over here. You cannot take over the share capital. You cannot take over the other equity balance. In fact, in lieu of that, you are actually paying the PC. And then comes the fourth point, which is the important point, where we have been told that we will take over the net assets. We will take over the net assets irrespective of whether these items appear in the books of the selling company or not. Like, for example, there may be certain in-process R&D. So let us say in the books of the selling company, who is a research company, who is doing research for AIDS, it has done a good 20 years worth of research of AIDS. It has not yet found a cure for AIDS, but it has a good enough 20 years work of literature. Now, you are a pharmaceutical company who wants to acquire it. For you, that literature is valuable, and hence you are ready to pay a fair value for that. In which case, we will take over that in-process R&D at fair value in the books of accounts. This is irrespective of the fact that in the individual books of the selling company, you might have classified this as a research and expensed it off to the P&L. In the books of the acquirer, if you are paying a fair value for that, it should be taken over as a part of your net assets taken over, irrespective of whether this was appearing in the selling company's individual books or not. That same logic and analogy also applies to other items, like certain brands. or customer relationships or lists which may not be recorded in the books of selling company, probably because the cost was not reliably measurable. However, as per Ind AS 103, you will take over assets and liabilities at fair value and not at their initial cost, and hence you will take over these items at fair value. So over here, when you look at in-process R&D, and that same logic as you see also applies to other intangibles like customer relationships, brands, etc. At the stage of business combination, you will take them over at fair values. The subsequent accounting for these will apply as per Ind AS 38. Like if you continue to do further research and you are still in the research phase, as per Ind AS 38, further research costs will be expense. If you are in the development phase, then development costs can be further capitalized, but that is subsequent accounting. Initial accounting at the business combination will be taken over at fair values. Okay, that is one special case. Another very important special case is what we call regarding contingent liabilities and indemnification assets. So sometimes what happens is in the books of the selling company, you apply Ind AS 37 and thereby you say that there is certain contingent liability like a pending lawsuit which you are going to give a disclosure. So you have fairly given a disclosure in the books of the selling company. However, when a purchasing company acquires this, they will obviously consider the fact that there is a lawsuit pending. Maybe the demand which was on the lawsuit is 100 rupees. We believe that on fair terms, maybe there's a 60% chance we will win, 40% chance we will lose. But if we lose, we have to pay 100. And hence, let us say the fair value for this would be 40 rupees. Now, in the books of the selling company, they might have said that if it is not probable that the payment will be made, we just want to give a disclosure. But when you acquire a business, the standard says all assets, all liabilities to be taken over at fair values, not necessarily whether they're probable or not probable. Over here, the fair value, if let us say it is 40 rupees, then you'll have to take over this contingent liability, for example, at 40 rupees. Okay, but so contingent liability should be taken over at fair values, irrespective of how the selling company accounts for it. Secondly, there is a possibility that the shareholder of the selling company gives you an indemnification. They say that, okay, this is a liability, but I don't want this to impact the acquisition, so I will give you indemnification. You continue the lawsuit, but whatever is the damages, I will pay you. Or they might say that I will pay you up to, let us say, a limit of 30 rupees. In which case, can you record an indemnification asset? Well, yes, as per Ind AS 103, irrespective of whether it was a contingent asset or not, you are allowed and required to show an indemnification asset, let us say at fair value. So when you show this, let us say at fair value, what will happen if this indemnification asset, let us say, is shown as a part of fair values? How will you calculate the fair value? Well, considering if the liability materializes, I'll have to pay 40 based on what I've taken over, and indemnification is permitted up to 30. That means I will record an indemnification asset of 30 as a part of my net assets. However, if the indemnification was agreed to be given up to 50, in my books, I'm taking over the liability at 40. I can't claim an indemnification of 50 if my liability is appearing at 40, and hence I will restrict it to 40 rupees. So basically, contingent liability at the part of initial recognition should be a part of net assets taken over, and this will be recorded at fair value. Sir, why not a part of PC? Because this payment is to be paid not to the owners. If it was payable to the owners, we take it as a part of PC. This is not payable to the owners, and hence will be a part of net assets since it is payable to outsiders. This is irrespective of whether it is probable or not. Maybe a contingent liability also comes along with an indemnification. They will also be recorded as a part of the net assets taken over at the value, considering the liability materializes. This is at initial recognition. Subsequent workings over here will be as per Ind AS 37, but the law over here mentions that for subsequent recognition, you will record the contingent liabilities till the time they are settled at the higher of the value as determined at initial recognition, in our example 40, or the value as per Ind AS 37, whichever is higher. This is probably because if you do not have this clause, what might happen at the very next day or very next balance sheet after the acquisition, you might apply Ind AS 37 and you might say that this liability is not probable, chalo, let us de-recognize it. The standard says no. You have taken it over at fair value, you will keep on showing this at fair value or the value as per Ind AS 37, selecting whichever is higher. Again, indemnification asset will be recorded on the same basis as the liability which it is indemnifying is recorded. So, the summary treatment at the stage of business combination, you will take over contingent liabilities, indemnification assets, in-process R&D, brands, customer relationships, etc. at fair values as on the acquisition date. The subsequent accounting will be done as per the respective standard. Another special treatment pertains to an item called as non-current assets held for sale, and in non-current assets held for sale, you will take over the assets and liabilities at fair value less cost to sell. Typically, for every item, you take over assets and liabilities at fair value. However, for non-current assets held for sale, in the books of the selling company, which the purchasing company also intends to hold for sale. The standard says, okay, you can take them over at the fair value less cost to sell rather than taking them over at fair value. So this is one small point. Fair value less cost to sell. One very, very, very important pointer in case of business combination at the time of net assets is the calculation of deferred tax adjustment. Institute purely loves asking you adjustment on this, which is pertaining to Ind AS 12. So for Ind AS 12 we have a separate discussion, but generally as per Ind AS 12 we say that there will be deferred tax which will arise if there's a temporary difference. So it is possible that your PP that you're taking over is at 500 fair value, but its carrying value is only 300. So when you go further in income tax will give you a shorter deduction. It will give you only 300 of deduction, whereas books will give you 500 deduction in the future, and hence there's a difference of 200. Institute believes, and again you're not solving a tax paper, you're solving an FR paper, so Institute believes that this difference of 200, which is resulting in you having to pay more tax in the future. Why? Because you're getting a short deduction, only 300 instead of 500. So this difference for which you have to pay a lesser tax in the future is a temporary difference. Whether it is temporary or other than temporary is debatable, but from an institute perspective, unless the question tells you, it is always assumed that the difference arising is a temporary difference. So for this 200 rupees, a deferred tax is to be calculated. If it's a taxable temporary difference, then deferred tax liability; a deductible temporary difference, then a deferred tax asset. The general thing that you can possibly do over here is you can calculate the net assets. Net assets as per Ind AS are at fair values, and net assets as per income tax are based on the tax base. If a tax base is given, you take that. If it is not given, you'll assume that it is the same as the old carrying value, because in income tax they don't recognize consolidation, so their tax assessment will happen based on the individual records of the subsidiary. So over here you will take the difference between the eligible net assets, that is net assets which can create a temporary difference, and unless otherwise given, we'll assume that the differences are temporary. So you will create a deferred tax over here for the difference. So difference into the tax rate will give you the deferred tax. The general rule that you follow would be that in case of net assets, if the carrying value is greater than the tax base, your answer should be opposite, that is, it will create a deferred tax liability. Whereas if the carrying value over here, that is the Ind AS value, is less than the tax base, then the answer will be in the same direction, it's a deferred tax asset. This rule concept detailing over here we would have done in Ind AS 12. I'm not again doing that over here. But when will we know that we need to do a deferred tax adjustment in the exam question? If two things are there. First, you have the Ind AS value, that is a fair value, as well as the income tax value or the old carrying values. You need to have a difference to calculate deferred tax. If there's only one value given, how can you calculate the deferred tax? There will be no difference. First, and second, there should be a tax rate. Sir, we know the tax rate is 30%, 25%. Don't be smart, or rather over smart. In that case, the standard will require to calculate deferred tax, but from an exam perspective, unless the tax rate is given, you don't have to sit and calculate the deferred tax. It is to be done only if the tax rate is given. So there are two ingredients. First, differences of fair values and let us say old carrying values. Second, tax rate should be given, and then in such case you have to do a deferred tax working. There can be various ways in which you can do this. You can find the net assets which create a difference, take the difference and do the deferred tax working, or you can do it only for individually those items which are creating the difference. Either ways works, but you get the right answer over here, and this is something which is very important. Sometimes the question might also have different tax rates for parent and subsidiary. Then what rate will you use? Well, you will use the tax rate of the subsidiary for creating deferred tax, because ultimately the deduction or additional taxation is going to come in the subsidiary's books, and subsidiary is individually assessed for tax separately from the parent. There is no CFS in income tax, and as a result, if you have to pay more tax or claim deductions, that will be in the subsidiary's tax records, in which case it will be created at the subsidiary's tax rate. So this is a very important adjustment, I would say, in case of net assets taken over. Further, another interesting point over here can be acquisition related expenses. Now, acquisition related expenses can be of two types. There can be direct acquisition related costs, like you have lawyer fee, banker fee, etc., which will be going to the P&L. It will not be a part of BC, it will not be a part of net assets, it will directly go to the P&L. Second is the costs which are incurred to register the assets in your name. Like for if you are acquiring land of some other company, you will have to pay stamp duty to register the land if required in your name. In which case, what do you do with the stamp duty? Well, typically we say stamp duty should be added to the cost of the land. But are you going to take over the land at cost? No, you are going to take over the land at fair value. In which case, if there are other expenses like a brokerage, a stamp duty, etc., these expenses which are also ancillary connected to the acquisition will be taken to the P&L. Under Ind AS 16, yes, you record the land at purchase price plus directly attributable expenses. However, this is not Ind AS 16, this is Ind AS 103, under which you will have to take over the land at its fair value, and if there is any cost which is incurred to get the land in your name, that cost will go to the profit and loss account. It is an acquisition related expense, will be taken to the profit and loss account. So basically, direct expenses linked to acquisition, legal fees, professional fees, all of these will go to the P&L. Even cost to register assets in your name will go to the P&L. There is only an exception over here, that there may be a possibility that there may be costs which are incurred for the issue of new shares. Then Ind AS 109 applies, and under Ind AS 109, if these are costs which are incurred for new shares that are issued, then as per the institute's treatment, this will be adjusted directly against reserves, that is retained earnings. So for example, you might be issuing new shares with a face value of 10 and a market price of, let us say, 40, that is a premium of 30 rupees. So in that case, in your PC, you will take PC at fair value, and fair value over here will be 40 rupees. So your PC will be calculated based on 40. And then let us say there are 5 rupees expenses. Then in your balance sheet, in the retained earnings or securities premium, you will subtract 5 rupees. So PC will be at fair value, but the acquisition cost of 5 rupees, instead of going to the statement of P&L account, since it is linked to issue of shares, it will be deducted directly from the retained earnings. So this is one small part. So these are two special adjustments when it comes to the workings in general. So you have done step number 4 as well. Net assets taken over, 100% of net assets at fair value, no share capital or reserves to be taken over, net assets to be taken over irrespective of whether these items individually appear in the selling company's books or no. You will take over these net assets. Perfect. Special cases over here can be contingent liabilities, indemnification asset, in-process R&D, brands, customer list relationships, etc. You will take them over at fair value at initial recognition, irrespective of whether they appear in the selling company's books or not. Non-current assets held for sale, you will take over at fair value less cost to sell. In case of a business combination where a tax rate is given and Ind AS values, that is fair values, and tax values, that is old carrying values, are available, there will be a hidden deferred tax adjustment to be done. The general rule is, for a net asset, if the carrying value, that is the Ind AS value, is greater than the tax base, you will get a deferred tax liability. If your carrying value is less than the tax base, then you will get a deferred tax asset. The detailed rationale for this is actually an Ind AS 12 or a deferred tax item. Acquisition related costs will go to the P&L, except if it is cost for fresh issue of shares as a part of the consideration, in which case it will be adjusted against a retained earnings or securities premium separately. Okay, so this is regarding net assets. Now there are a few other points as well, but before that you go to the step 5. That is non-controlling interest or NCI. Why do we do NCI step 5 and not at step 4? Because NCI has two methods. It is either calculated using the fair market value method, that is a market price, or the proportionate net assets method. Now first of all, what is NCI? Why is it created? Well, it is created at the stage of a holding subsidiary relationship, because a parent might acquire 80% stake in a subsidiary, and by virtue of that 80% stake, parent can control a subsidiary. Now because it is controlling, it will take over all assets and liabilities, but these assets and liabilities will be taken over 100%, but you own only 80%, and hence out of this 100% of assets, we attribute 20% to a non-controlling interest shareholder. This is called as NCI. This non-controlling shareholder still is an equity shareholder. They still evidence what you call as residual interest. They may not be controlling, but the definition of equity is that you should have a residual interest. You get more, you get less. That is also a feature of NCI, and hence NCI will be shown as a part of equity. You will show equity share capital, other equity, and then you can also show non-controlling interest. You not keep it hanging like you do in your CA Inter. Minority interest will not be shown between shareholders' funds and non-current liabilities. Non-controlling interest will be shown as a part of what we call as equity. Okay, now how do you measure the non-controlling interest? Two methods are there. First, as on the acquisition date, you can take the fair market value of NCI. Let us say there were 100 shares in the selling company, out of which 80% we have acquired. The remaining 20% is not yet acquired. So 20 into the market price or the fair value as given. Let us say the market price is 5 rupees, and hence NCI would be 100. In such a case, fair market value method. Or you might say that, okay, I don't need to look at the quoted market price, etc. I can look at, let us say, the net assets, fair value of net assets that I am taking over. Let us say the net assets that are taken over, for example, are worth 80 rupees. So we can say 80 into 20%. No. 80 to काफी कम है. Let us say they are worth 400 rupees. So 400 rupees into 20%, that is coming to 80 rupees. So over here 80 can be NCI using proportionate net assets method. Now in the exam, which method to use? Generally, if nothing is given, you will use the proportionate net assets method because the fair value of net assets taken over would almost always be available. But if the question specifically tells you that it wants to measure the NCI using the quoted market price or fair value method, then you can take that from an exam perspective. Sir, what is the difference over here? Well, the difference will arise at the stage of goodwill calculation. Now, how do you calculate goodwill? So you are at NCI, and from NCI you need to go to goodwill. Now, how do you calculate goodwill? Now, typically in your CA Inter, you would calculate goodwill as PC minus net assets. The problem is, in CA Inter amalgamation or absorption, typically you take over 100% of the business, and hence PC is for 100%, net assets are also 100%. However, in a holding subsidiary relationship, it is possible that you pay PC only for an 80% stake. However, the net assets, you take over 100%. So can you compare PC with 100% of the net assets to calculate goodwill? The answer is no. So the goodwill is calculated as PC plus NCI minus net assets. Again, PC plus NCI minus net assets. So over here, if let us say in this particular case you have to calculate goodwill, we can say that PC, let us say for example you are paying 5 rupees for 80 shares, so 80 into 5, that comes to I think 400 rupees. PC is 400 plus NCI. Well, NCI can be calculated using the fair value method, in which case NCI is 100, or NCI can be calculated using the proportionate net assets method, in which case the NCI can be 80. So this is proportionate net assets method. PC, remember, is going to remain the same. You are paying 80 shares, ke liye 5 rupees, that is 400 rupees you are paying. Net assets you are taking over is still going to be, for example, over here we have taken in an example, net assets are 400. So let us say you are still going to take 400. And hence, if I were to take the difference over here, this difference will come to 100, this difference will come to 80. What is this? Well, this is called as goodwill. Now this 100 is called as full goodwill, F for NCI at fair value, F for full goodwill, and this 80 is called as partial goodwill, P for proportionate net assets at NCI and P for partial goodwill. Now why is this partial? Well, because in this case I am not looking at any premium in the NCI. I am saying that, well, you know what, I am acquiring a company which is having a net assets worth of 400 into I am acquiring an 80% stake, so effectively I am getting net assets worth 320. But how much am I paying for this 320? Well, if a liquidation happens, I'll get 320 today, but for that I'm actually paying 400, and hence the difference of 80 is the excess I'm paying only for my 80% stake. However, what if I look at NCI? If I go to acquire NCI, we say acha, NCI value is 80, which is a percentage of net assets only. However, is it possible that if I go actually in the market to acquire the NCI, will the NCI sell their shares to me at 80 rupees? No, they will say that in the market we are getting 5 rupees. At least 20 to 5, you have to pay me 100 rupees. So over here, when I say that, I will say that, okay, if I were to acquire 100% stake, I'll have to pay 400 for the 80% stake, plus I'll have to pay 100, and hence I'll have to pay total 500 against net assets of 400, and hence for the company as a whole, the goodwill is 100. Now whether I acquire 80% stake, I acquire 100% stake, it does not really matter. For everything else, you are showing 100% of assets and liabilities. So in my opinion, it is quite logical to say full goodwill should be followed. However, the law does not specifically require you to follow full or partial goodwill. So the institute typically, if nothing is given, follows the partial goodwill method, and hence we will also do that. So when will we do full goodwill? If the question tells you, or it gives you directly a quoted market price. You will not do a cross multiplication and say, okay, chalo, if 80% is equal to 400, then 20% is equal to how much? No, unless the question tells you, you will not do that. So these are two methods to calculate NCI, and it is quite important because these methods actually give you goodwill. So PC plus NCI minus net assets, if the difference is positive, the difference is called as goodwill. However, is it possible that the difference is negative? Well, that is treated to be extremely rare. Why? Well, why would a company sell at less than its net assets value? It can do a piecemeal dissolution and still get the net assets value. Why would the company do that? So the standard believes that there would be some inherent possible error, and hence you are getting a negative balance. It requires you to reassess everything, the PC, the NCI, the net assets. It requires you to reassess the fair value, and if the difference still comes out to be negative, well, it says we'll have to accept it. But otherwise, it shows that you have to reassess. for all of these values. And if it is still negative, then what do you show this? Well, people say capital reserve. Well, in general, yes, you show it as capital reserve. But why capital reserve? Because it is a profit on purchase. This is the only place in your entire syllabus where you record a profit on purchase. Everywhere else, a profit is recorded on sale. Over here, it's such a special item that on purchasing, you're recording a profit. And hence, this is special in nature. And hence, AS, IND AS, both of them require you to take it into the capital reserve in general. However, IND AS has an additional layer of complexity. It says that, okay, it is going directly to capital reserve, so it is not appearing in P&L, it is not appearing in OCI. A reader does not really see that in the income statement. It directly goes to the capital reserve. It is a capital profit undoubtedly. However, if there are reasons because of which this deal is happening, where you are striking a bargain, like for example, TikTok was banned in India, it got 90 days to close up its business. You struck a deal, acquired TikTok, for example, at a bargain, or there was a forced court order or a distress sale that was happening. There are reasons why you struck a bargain, and hence that 20 or whatever can be shown as a gain on bargain purchase as a part of other comprehensive income. But then that gain on bargain purchase will not be shown as a separate line item like fair value reserve, revaluation reserve. It will not be shown as a separate line item. That gain on bargain purchase will be accumulated ultimately along with capital reserve only. But a reader, when he looks at the financial statements, remember you're doing financial reporting. So when he looks at the financial statements, he will see that, okay, during the year a bargain was struck. But that you can do only if you're confident enough. That is, you can see that there's a reason why this deal is happening at a cheaper price. Otherwise, if there's no reasons why this deal, you can say, is happening at a cheaper price, no distress sale, no court order, etc., in which case the difference, if any, after all of these reassessments, will directly be accumulated in capital reserve. So if there's a 20 rupees gain on bargain purchase, you have an opening capital reserve, then in the other equity section, you will directly add 20 over there. In case it is a gain on bargain purchase, you will show the 20 as a part of other comprehensive income, and then rather than showing gain on bargain purchase as a separate line item, we'll accumulate it along with the capital reserve. It's a little tricky or confusing. Just for knowledge, IFRS has a slightly different treatment. So at this point there is a carve out, but we are not studying IFRS, so we will not go into that over here. This is gain on bargain purchase in OCI, and if there are no reasons attributable, this will go to the capital reserve. So these are your 6 steps of business combination accounting. Step 1, acquirer. Step 2, acquisition date. Step 3, PC. Step 4, net assets. Step 5, NCI, one of the 2 methods. And again, step 6, which is goodwill or gain on bargain purchase gain or capital reserve as the case may be. So these are your various cases. A few special points that you should be aware of, for which Institute has given you certain guidance. First is, what if there is non-replacement awards? So what is a non-replacement award? We studied some time back regarding replacement awards. Replacement awards is nothing but there was Tata Motors who was acquiring JLR, and as a part of the acquisition, it takes over the ESOP scheme of JLR and it issues its own options. So it is acquiring the ESOP holders who are owners of the JLR and in return giving them your own ESOPs. It is like saying that if there were equity shareholders in JLR and if I acquired those equity shareholders and issued them my own shares, that would be a part of PC. However, if out of 100 equity shareholders you acquired only 80, the remaining 20 you don't acquire. These are still shareholders of the selling company, owners of the selling company, and hence they are called as NCI. In a similar way, a non-replacement award is a scheme where there's a scheme of JLR. Ideally, you should take it over and issue your own options, but the employees of JLR don't want that, in which case you don't acquire it, which means these employees, if they continue serving, they will ultimately get shares of JLR only. They will not get shares of Tata Motors. So these are owners of the selling company that you are not acquiring, and hence this will go as NCI. All else remaining the same. Your entire working remaining the same. It is just that instead of treating a replacement award, which is a part of PC, at the pre-combination element value, a non-replacement award again will be treated as a part of NCI separately from your equity shareholders. It will be treated as a part of NCI again at the same pre-combination value, because even after the acquisition, these employees may continue to give service to JLR, and hence a part of the compensation may be linked to post-employment service. The examples that we were discussing were for 75 rupees, which is the fair value of the award. So we can say 75 into 2 by 5, that is 30 rupees, will be treated as compensation for pre-combination service, but you are not paying them. But then it is still owners of the selling company which are not acquired, and hence it is a part of NCI. For the remaining, let us say in this case 75 minus 30, because you are not acquiring, so there is no replacement at 90. 75 minus 30, that is 45, will be spread over the remaining 2 years, 3 years, whatever is the vesting period. Again, EB account debit to, in this case, NCI. You will not credit the SBP reserve in your consolidated statements because Tata Motors is not going to issue any options. It is JLR, and if JLR issues shares, well, that is diluting your owning, and hence it is an NCI. So this is in case there is a non-replacement award. Then all else remaining constant, instead of SBP reserve, and PC at initial recognition, you will show it as a part of NCI. Subsequently, it will still be EB account debit. Instead of SBB reserve, you will credit the NCI. Okay, then you have certain components of consideration. Sometimes what might happen is, as a part of the transaction, you are acquiring business, but as a part of that, some other existing contractual or non-contractual relationships get settled, or you agree to pay something for a new relationship that is established. So remember, PC is a payment that you make for acquiring control over the selling company. That is payment in lieu of acquisition of control over a business. If that payment is in lieu of something else, that is not to be taken as a part of PC. Like, for example, there may be a pending lawsuit between the purchaser and the selling company, and if as a part of the transaction that pending lawsuit is getting settled, where selling company was suing the purchasing company, then a part of your total consideration is for the implicit settlement of this lawsuit, and hence that should be separated out from PC and recorded separately. So over here, if there's an existing relationship, it may be non-contractual, like a lawsuit was pending, then we will say that this lawsuit implicitly settles, let us say, at the fair value, and if required, you can calculate the gain or loss on this settlement as well separately. Further, if there's an existing contractual relationship, let us say there was a license which was there, and as a part of this acquisition, the existing contractual relationship gets settled. Technically, strictly speaking, you should also settle this at fair value only. However, the standard says that if it is contractual, there is a possibility that you have two choices. You can either acquire this by paying the fair value, or you can settle it by closing the contract and paying the settlement value. So the standard over here says that you will take the value for this existing contractual relationship at the lower of the fair value. In this case, it should subtract the carrying value as well. So fair value minus the carrying value or settlement value, whichever is lower. Over here, there can be some debatable points, but from an exam perspective, it is not as important. If it comes, just remember this and proceed. So over here, contractual, which is lower of the fair value minus the carrying value or the settlement value, and this will give you, let us say, the amount for the purpose of settlement of existing contractual relationship. Either of these have, in my understanding, not come. The only thing that has come, maybe directly or indirectly, is a component of a consideration for a new relationship, that is an employer-employee relationship. Typically, let us say, if I am the sole owner of my company and an acquirer acquires my company, they pay me a consideration that is a part of PC, because that is in link to acquisition of control over a business. However, I am the whole and soul. I am the key management personnel of the company as well, and hence the new company wants to retain me. So they say, okay, you know what, 100 rupees we are paying for your business, and remaining 20 rupees additional we are ready to pay if you continue for 3 more years in my company. So total 120 is paid, but is that 20 additional linked to you as an owner, or is in the capacity of an employee? Well, it is in the capacity of an employee, and hence that additional 20 rupees will not be a part of PC. In fact, it will again be a remuneration cost to be recorded as per Ind AS 19 over the service tenure. Now, the problem is to distinguish between the fact that whether there is an employee shareholder, is a payment going to them in lieu of service, or is it in lieu of business? So it is very much possible that I say that I don't want to continue for 3 years in your company. So let us say there can also be another possibility that 100 is paid today and 20 will be paid if over the next 3 years the company shows a growth of 20% in sales, for example. Then you will get another 20 rupees. Now that I'm getting because I'm an owner of the selling company, not because I'm rendering service over there. Then 100 plus the fair value of the contingent consideration will always be a part of PC. However, if it is linked to employee service, it will not be a part of PC. The problem is if both of the conditions are there. If you are going to get additional 20 as an owner, provided the business clocks a 20% growth rate over the next 3 years, and you have to remain in service. So if even one of the conditions is linked to employee service, we would say that that part will not be a part of PC, and as per a specific guidance under Ind AS 103, we will take it as a part of remuneration cost. It is not even a part of net assets. This to be recorded as and when service is rendered. So over here, this is contingent consideration versus contingent payment linked to employee service. If one of the payments is linked to employee service, it is not a part of contingent consideration, that is PC. It will be taken as contingent payment to employees, not even a part of net assets, to be recorded as and when service is rendered. Okay. Next, there is another important concept of something called as measurement period. Now, what do you mean by measurement period? Measurement period refers to the period which starts from the acquisition date and runs for a period of 12 months. Okay, usually like you do a post-balance sheet period working in Ind AS 10, a measurement period starts from the acquisition date and runs up to 12 months from the acquisition date. So during this period, if there is additional information which is obtained which pertains to conditions which are existing on the acquisition date. Remember, if there are new developments that are happening after the acquisition date, it does not matter. So two conditions have to be fulfilled for measurement period adjustment. If first, new information is obtained within 12 months. Second, pertaining to a condition existing on the acquisition date. If both of these conditions are fulfilled, then the standard allows you to reassess and remeasure the PC plus NCI minus net assets and thereby remeasure the goodwill. But sir, goodwill was already calculated. Net assets were already calculated. NCI was already calculated. That was done on a provisional basis. In a practical scenario with so many moving parts, so many variables, it is very difficult to get all the reliable information on the very date of acquisition, and hence you might keep on obtaining new information. But again, you have to draw a cutoff. So within 12 months from the acquisition date, if that information pertains to a condition which was existing on the acquisition date, then we call this as a measurement period adjustment, where we reassess the PC if required, the NCI if required, the net assets if required, and the balance will go to the goodwill. So there may be an adjusting entry where goodwill gets impacted. The second effect can go to the net assets. It can also go to the NCI if the NCI is based on a percentage of net assets. So let us say in the post-acquisition period, within 12 months, you detect that there were certain customer relationships or brands which you missed recording within 12 months, in which case you record the brands. If you record the brand as a separate asset, your net assets change. If your net assets change, your goodwill will also change. But if your net assets change and NCI is calculated using a percentage of net assets, then that net assets will also change, or NCI will also change. And thereby you will do a measurement period adjustment. A fairly interesting question, question number 59, was there in our books or even there in a study material, where there are interesting measurement period adjustments pertaining to customer relationships, etc. So this is a measurement period adjustment. For you to do a measurement period adjustment, both conditions should be met, that is goodwill or capital reserve should be adjusted, that is within 12 months and pertaining to a condition existing as on the acquisition date. And if one or none of them are met, then we will say, okay, we will not really adjust, we will just adjust PNL or the respective standard. So this pertains to a broad discussion regarding business combination. You still have to discuss regarding common control combinations, regarding reverse acquisition. But before that, we can probably try two relevant questions regarding business combination. We could have we will just discuss this once. So if you go to your this question is a May 23 question number 5 over here. This is a May 23 exam question. I would mark this question as fairly important. Now ideally, earlier we used to do two separate questions, which you can still do. A question of professional and dynamic, which is question 58 of our books. This question includes all the adjustments, all of them, which are there in the professional dynamic question, and hence if you do this, professional dynamic automatically gets done. And second, there is a question 59, which is a very big question of H limited and S limited, where you have a lot of items, measurement period adjustments, where in the institute has imported a couple of important points from that question over here. So rather than doing 58 and 59 right now, we are doing question 5 from the institute May 23 paper. If you want, you can also separately refer that 58, 59 professional dynamic as well as H limited, S limited questions separately. These are also good questions which you should try to do on pen and paper. Currently, we do the May 23 exam question. So let us go to the May 23 question. The draft balance sheets of Swan and Duck are given on 31st March 2023. So this is 31st March 23 balance sheet. As you can see, a fairly detailed balance sheet would be given, and then there are a few adjustments. On 1st April 23, Swan acquired 80% of equity shares of Duck. So 1st April 23 seems to be the acquisition date and Swan seems to be the acquirer. Swan agreed to pay to each shareholder of Duck rupees 20 per share in cash. So this is definitely a part of PC. So if you look at the number of shares over here, it appears that Duck has equity shares of rupees 10 each. These are probably 900 shares of rupees 100 each, sorry. And then this is 9. Maybe this is given in lakhs. Yes, this is given in lakhs. So this is 9 lakh shares. And for each of those 9 lakh shares, you are agreeing to pay cash. So this is 9 into 20. Okay. And to issue 5 equity shares of rupees 10 each of Swan in lieu of every 6 shares held by the shareholders of Duck. The fair value of the shares of Swan was 100 as on the date of acquisition. So this is your cash, which is a part of PC. Apart from that, you will have shares issued. So when I go to see, there are 9 lakh shares. So if we see the working over here, there are 9 lakh shares, but are we acquiring all of them? No, we are acquiring 80% of that. It is 7.2 lakhs, which means you are said that for every 6 shares, we are issuing 5 shares. So the exchange ratio is 5:6, and hence this is what, 7.2 lakhs into 5 by 6, which comes to around 6 lakh shares into rupees 100, if I am not wrong. Okay, so this is into 100, which is a value of Swan, and hence the value over here will be again 7.2 into 5 by 6 into 100, which comes to 600. So this will be 600 worth of shares, which will very well be a part of PC. So these two are PC items. This entire paragraph is PC. Swan also agreed to pay an additional consideration being higher of 90 lakhs and 30% of excess profit in the first year after acquisition over Duck's profits in the preceding 12 months. Both of these adjustments are quite similar to the professional dynamic question, which is there in the study material as well. Made by Duck, the additional amount will be due in 3 years post the date of acquisition, and Duck earned an amount of 30 lakh profit in the preceding year and expects to earn another 40 lakhs in the next year. So basically over here, this is additional consideration to be paid to the owners, and hence this is also treated to be a part of PC. So if we look at the workings over here, what is a payment? Well, the payment made is a higher of a fixed amount, which is I think 90 lakhs, or an additional amount which is calculated as 40 minus 30 into 30%. So probably this is 10 into 30%, which is 3. So higher of the two is 90. So do I have to necessarily pay 90? Yes. 90 has to be paid, and hence this can be taken as deferred consideration. If this was anything above 90, then the additional part can be used as a base for contingent consideration. So over here, 90 is to be paid after 3 years. Do we have the discount rate? Well, it is not given in this paragraph, but if you see point 8 of this question, assume 10% per annum to be the discount rate. So basically you can say as a part of deferred consideration, you will take 90 into discount factor, that is 7513. So probably 90 into 0.7513 comes to around 67.62. So over here 67.62 will be deferred consideration, which is a part of PC. So what all is a part of PC? Cash, I think of 20 into 80, 600 worth of shares, and another 67.2 of deferred consideration. Okay, so all this is a part of PC. The fair value exercise resulted in the following. The fair value of PP and investments of Duck on 1st April was 1200 and 300 respectively. So if I go to see, the fair value is 1200, and for investments this is 300. This is specifically given to us. Okay, so this will be taken for the purpose of net assets taken over. Duck owns a popular brand which meets the recognition criteria of intangible assets under Ind AS 103. So it clearly tells that it is a separately identifiable assets, will be considered under 103. Independent valuers have attributed a fair value of 250 lakhs for the brand. Okay, so that is at fair value. Should you take over? Well, answer is yes. So over here we can possibly have another line item, let us say for the brand which is taken over, which is worth 250 lakhs. Perfect. However, okay, this is the sentence which has created a lot of unrest, I would say, in students, where we are told that however the brand does not have any cost for tax purposes and no tax deductions are available regarding the same. Now for net assets taken over, you will obviously take over the brand at fair value, and hence the fair value of this brand should be taken over, 250. However, when we look at this sentence, on the face of it, it appears that on the face of it that brand should not have any tax impact. So there is no deferred tax, but that is not exactly what this question tells you. If you go to see, what is written over here is that the brand does not have any cost for tax purposes. Right time pe ye nahi chal raha hai. Just a second. The brand does not have any cost for tax purposes. What does it mean? Well, unless given otherwise, when you look at books of accounts in the consolidated financial statements, you will take over assets and liabilities, that is including brand at fair value. But income tax is based on the individual records of Duck. Now, merely because Swan is taking over the assets and liabilities at fair value, including brand at 250, does not mean income tax will record any asset called as brand in its balance sheet. Perfect. So there will be no cost for the purpose of tax, which means there will be no brand appearing as an asset in the income tax balance sheet. Perfect. and no tax deductions are available regarding the same. So tax deductions are similar to depreciation or amortization. So over here we are saying that since brand is not appearing as a separate asset in the income tax balance sheet, there will be no amortizations or depreciations attributable to the brand, but that is obvious. There is no brand asset in the income tax balance sheet. There will be no question of a depreciation or amortization on that brand. However, does the question anywhere tell you that there will be no income tax consequences? There are no temporary differences. No, it does not tell you. You might be confused looking at this adjustment vis-a-vis the adjustment done in question number 59 of the study material of our material. Maybe that is also, I don't remember the institute study material question, that big question where you have the customer relationships. In that question, it was given that the customer relationships do not create any temporary differences and will have no deferred tax impact. It was absolutely loud and clear terms. It was given that there would be no tax impact. That is not given over here, which implies that yes, brand does not have a cost for tax purposes. It will not get a tax deduction. However, if this brand, let us say, was separately sold for an X amount, will income tax charge me any income on that? Well, yes, it will definitely charge me any tax on this. It is nowhere given that the proceeds from the brand are tax exempt. If it is sold separately, whether it had a tax asset or not, if it is sold separately, the question nowhere tells you that the brand will not have any income tax consequence. And hence, if it is sold in the future, let us say for simplicity at 250 rupees in the books for 250, I would say bank account debit 250 to brand 250, and hence there would be no separate income on account of the brand. However, when we look at, for example, income tax, in income tax, my entry will be bank account debit 250 to, let us again, 250. So this will result in you having to pay more tax in the future. And hence, in this question, institute has calculated tax impact on the brand, deferred tax impact. We will also do that. You should be able to distinguish the language. Over here, it is just given that it does not have any cost for tax purposes, which means in the tax balance sheet, brand will not appear. And hence, consequently, there will be no deductions or amortizations on account of the brand. However, by no means does it say that there would be no temporary difference or no deferred tax impact. And hence, we will calculate the deferred tax in line with what the institute has done. Okay, so this is pertaining to brand and its deferred tax impact, a fairly important and a slightly controversial or debatable adjustment. Following is a statement of contingent liabilities of DUC as on 1st April 23. Should you take over the contingent liabilities? Well, yes. At what value? Well, fair value, irrespective of whether they are probable or not probable. Like lawsuit filed by the customer for a claim of 20 lakhs. If it is filed by the customer and if a payment has to be made, it will be paid to the customer only, and hence it is more like a part of net assets, not a part of PC. It is not probable that an outflow of resources would be required to settle the claim. Any amount which would be paid in respect of the lawsuit will be tax deductible. So if you end up paying something, you will get a tax deduction for the same. Fair value is 5 lakhs. Should this be considered as a part of net assets taken over? Yes. Income tax demand of 70 lakhs raised by the authorities. DUC has challenged the demand in the court. The fair value is 20 lakhs. Again, it is not probable that an outflow of resources would be required. They have not mentioned anything regarding tax, but remember, income tax is not itself allowed as a deduction while calculating income tax. So if you pay based on this demand, that will not reduce your taxable profit of the future years, and hence there will be no tax consequence over here. But still, is it a part of my net assets? Well, yes. And hence at fair value, 5 and 20, that is 25, would be pertaining to the net assets working over here. So when you do the net assets working, just a second, you will definitely consider the brand. You will definitely consider the fair value of all of these assets and liabilities, but at the same time, you will also have certain liabilities. I probably don't have enough space over here. I'm just writing it over here. So there will be certain lawsuit liabilities. Well, it can be 5 and 20, totaling up, let us say, to 25 rupees. This will be, let us say, totaling up to 25 rupees. Tax impact will study separately. Now, DUC had certain equity settled share-based payment awards called as original awards, and which were replaced by new awards, which means there is a replacement. So this will be a part of PC to the extent of pre-combination element by SWAN. As per the terms of the original awards, the vesting period was 5 years, and as of the acquisition date, the employees of DUC have already served 2 years. So 2 years are served, 3 years are remaining. As per the new awards, the vesting period has been reduced to 1 year from the acquisition date, which means the revised vesting period will be 2 years, which is already served plus 1 remaining, and hence it will be 3 years. The fair value of the award on the acquisition date was as follows. So original awards is 12 lakhs and the new awards is, let us say, 18 lakhs. So over here, how would this adjustment impact? Well, this will impact PC at the stage of acquisition, and subsequently it will impact the EB over the year. So if I want to find the pre-combination element, which should be a part of PC, I will take 12 lakhs into the vesting period served, that is 2 upon the longer of the original vesting period, which is 5 years, or the revised vesting period, which is 3 years, and hence this is 2 by 5, and hence this will come to 4.8. So this 4.8 will be a part of PC. Now for academic completion, if you want to figure out how much will be a part of the post combination element, you will say out of the post combination element total is 18 minus 4.8, and hence ideally 13.2 should be taken as a part of your post combination element, and currently this will not be a part of net assets, it will not be a part of BC, it will be recorded as remuneration cost as and when service is rendered. Okay, so as of now this will also be a part of PC. So what all is a part of PC? Cash paid 180, shares issued 600, deferred consideration 67.62, and 4.8, which is a purchase consideration. Further, Swan also agreed to pay one of the founder shareholders of Duck a sum of 15 lakhs. This is paid to the founder shareholder. Okay, so it is paid to the owner, so probably it could be a part of BC, provided he stays in the company for 2 years after the acquisition date. In this case, this is a payment linked to service, and if it is a payment which is linked to service, it cannot be a part of PC. This will again be remuneration cost to be recorded over the next 1 or 2 years, and will have no impact on the PC or net assets. You will have to write a separate note for this. Okay, then there is another new adjustment, which is the acquisition cost of Swan for Duck was 26 lakhs. Remember, acquisition cost has to go to the P&L, and hence it will not impact the goodwill working. However, we need to give a separate effect while preparing the balance sheet. If we have not given, we will give that separate effect. The applicable tax rate for both companies is 30%. With this, you will need to do a deferred tax working. This will impact the net assets, because if a tax rate is given and different fair values and carrying values are available, you will have to calculate the deferred tax adjustment. The discount rate is 10%. Also assume, unless otherwise stated, that all items have a fair value and tax base equal to their carrying values. So if nothing is given, we will assume that your old carrying values will be equal to your tax basis. You are required to prepare the opening consolidated balance sheet of Swan as on 1st April 23. Working note should form a part of your answer. So basically, if I go to see, your PC will be 180 plus 600 plus 67.62 plus around 4.8. So if you take all of this, what is this? 780 plus 67.62 plus 4.8, which comes to what? 852.42. This must be your PC. If you go to see, ideally this should appear. I think there is some, oh, I missed a small point over there. Okay, my bad. Over here, this is 9 lakh shares. For each share acquired, you are paying, 20 rupees. But are you acquiring all the shares? No, you are acquiring 80% of the shares. See, things like this, again, these are called as silly mistakes. If you make them, they can prove to be quite costly. So this is 9 into 80% and into rupees 20. And if you go to see, this will come to, let us say, 144. Not 180, it is 144. So this is, let us say, all else remaining constant, this is 144 rupees. Maybe some of you would have already corrected this beforehand, but nevertheless, so over here, let us say we take this as 144, and hence over here you will have your total value is 816.42. so this was 816.42. now other than that, you will have to calculate your working for your net assets. So when you do the net assets working, you will take over all assets at fair value, which will include brand, PP, investment. So this is what? 250, 1200, 250, 1200, 300 plus 260. You will take all of this plus 540 plus 290 plus 350. All of this put together would give you the net assets minus a liability. So liabilities comprise of long-term borrowings, that is minus 3150, I think is the total assets, minus 500 minus 200. You will also subtract 25 for the contingent liabilities, minus 25 minus 290 and minus 370. So this is 1805. This is net assets taken over before the deferred tax adjustment. Now deferred tax adjustment, you can either take the fair value of the eligible assets and liabilities, compare it with the carrying value, find the difference, or what you can do is you can take those respective items which are creating deferred tax. So what all are the items which create deferred tax? First is PPE. This is an underlying asset. Then there is investment. Again, this is an underlying asset. Then even there is brand. As we discussed, this will also create a deferred tax. It is an underlying asset, and just the customer lawsuit liability. This is an underlying liability. You will not take the income tax litigation because that is not having any tax consequences. First you take the carrying value, which is as per Ind AS. So for the PP this is 1200, investments this is 300, brand this is 250, and over here this is 5. Then you take the tax base. Tax base as per the books over here I think will be 1000, then 240, then you have 0. The question very clearly tells you it has 0 cost for tax purposes, and also customer lawsuit liability is not appearing in the standalone books, so it will not have any income tax consequences even individual. So there is a difference. You can either take the total. What ICAI has done is they have taken total. They have said that okay, all of these are assets, the last one is a liability. You can take the total, or you can do individually. This is 200, this is 60, 250 and 5. Each of these places you have carrying value is greater than the tax base for each of these items, and hence the answer is opposite. So over here the deferred tax impact over here in the longer method would be 200 into 30%, this is 60 DTL, 60 into 30%, this is I think 18 DTL, 250 into 30%, 75 again DTL. Why? Because an asset creates an opposite effect. So an asset will create a deferred tax liability. Like brand, in income tax you will get no further deductions or anything for in books you will get. So this will result in you having to pay more tax in income tax records, and hence a DTL. Over here it is opposite, so it creates a DTA. 5 into, so this is 1.5, and hence if I were to total this all the DTLs, so this is what, 78 and 75, and then minus 1.5, this comes to what, 151.5. This is your net DTL. What ICAI has done is they have directly taken the net balances. They have said all assets minus liability, so that is 1200 plus 300 plus 250 minus 5, because it is a liability. So this is what, 1745, and this is 1240. The difference over here is probably 505, and 505 is where net assets are greater into 30% will still give you 151.5, which is a deferred tax liability. So if it is a deferred tax liability, what do? Do we add or subtract? Sir, we subtract, and hence we calculate a deferred tax liability over here, and we find the net assets. So if you were to find the net assets taken over, this is 1805 fair value minus 151.5, 1805 minus 151.5, and you are left with 1653.5. Now NCI, there's a 20% stake held by non-controlling holders. We have not been told the method, so we will use proportionate net assets. 1653.5 into, let us say, 20%. So into 20% will come to, let us say, 330.7. So this will be your non-controlling interest, let us say 330.7, and hence you can use this for the purpose of goodwill or capital reserve workings. So this is PC, that is 816.42 plus NCI, which is 330.7 minus net assets, which is 1653.5, and hence the answer is negative. If it is negative, it is a capital reserve or a gain on bargain purchase, as a case may be. So this is how much? This is probably 506.38, which can be called as a capital reserve or a gain on bargain purchase. So if you go to see, hopefully our numbers will possibly tally. So this is 816, the big net assets taken over working, which is 1805, then the deferred tax working of 151, a problem for brand you will have to consider, and then you get NCS 330, and 506.38 is a gain on bargain purchase or capital reserve. But the question still wants you to prepare the consolidated balance sheet. So if you were to prepare the consolidated balance sheet, will there be any changes? Well, yes, you will take over all assets and all liabilities. But other than that, there is an acquisition cost as well of 26 rupees. The journal entry will be the profit and loss account debit. So in Swan's books, there will be an expense and cash will reduce. Apart from that, there will be various considerations that are paid. So over here, if I were to prepare the consolidated balance sheet, there will be PP, which starts at 800 and 1200, which is probably 2000, 900 and 300. This is probably, I think, 1200. Brand will separately appear at 250 rupees. No further adjustments, you will take them over. This is, I mean, obviously you will have to do the Schedule 3 format, but 360 and 260 will come to, let us say, 620 rupees. Trade receivables, if I total up 1040 and 540, comes to around 1580. Cash, you have to be careful, 1580. You are paying from this 550, you are paying 144 worth of cash, and you are also paying 26 worth of cash. So this is 520 minus 144. minus 26 and then plus 290. So your total comes to, let us say, 640 for the cash, and for other current assets this is 1050. When you look at equity share capital for Swan, this is 1200. You will not take over the shares of Duck, however you will issue consideration, and this consideration is probably 6 lakh shares of rupees 100, but the face value is 10. So 6 lakhs into 10, this is I think 60, so this will come to 1260. There would be Duck, and in Duck you will have no share capital, but when you look at other equity, you will not take over the reserves of Duck. However, 1450 minus this, you will have 26 rupees. So this will be 1450 minus 26 for the acquisition cost, and 1424. So basically this is going to be 1424, but over and above that there will be a few other items that come from PC, like the securities premium. 6 lakh shares at a premium of 90, so that is going to come to 540, which is a securities premium. There is a SBP reserve, I think of 4.8 if I'm not wrong, which will come over here, and there's also a capital reserve of 506.38. So if I total all of this, 1424, 540, 4.8 and 506.38, I think 506.38 was the balance. So this will give you I think 2475.18, just 2475.18. So if you go to see over here in the other equity, okay, there you go, the other equity balance, all of this put together 2475.18, one of the most complex adjustments. Then you look at other assets and liabilities. Remember, there is a deferred tax liability as well. Apart from all of this, you will also have a deferred tax liability. So all said and done, this is 2475.18. There will be an NCI, non-controlling interest, of 330.7. Other than that, you will have long-term borrowings of what, 1200, long-term provisions of 340, a deferred tax liability of 80 and 25. 80 and 25 comes to what, 105. Short-term borrowings of 540, trade payables of 870, and if all goes well, your balance sheet would tally at around 7340. So this is your balance sheet tallying at around 7340. Okay, so that takes care of a fairly interesting and detailed question, something that I would strongly recommend you to practice on your own on pen and paper as well, because it has so many interesting adjustments and it has also come in the exam. Okay, the other question which is there is, I think, question number 4, which is similar to a question which was asked in the exam and has also come in the recent May 24 RTP. It's a fairly easy question. Here we have included because here we want to show that what will happen if there is an existing investment which gets remeasured. So on 1st April 11, PQR acquired 30% of the voting rights of X for 8,000. So that is 30%. So that gives significant influence. You will initially record it at cost and then measure it using the equity method, 8,000. PQR accounts for this investment using the equity method, that is right, as prescribed under Ind AS 28. As per 31st March 12, that is 1 year later, PQR recognized its share. Its share is already the 30% share of net asset changes of XYZ using the equity method. Is that correct? Well, yes. So under the equity method, you will start investment account debit to bank 8,000, and then you will recognize in your investment account debit to, let us say, consolidated PNL. So to this 8,000, you will add investment account debit to consolidated PNL, your share of profit, to consolidated exchange differences, maybe FCTR, to consolidated FCTR, to consolidated revaluation reserve, and these are all changes in equity, and if you total all of this, probably this will come to 8850. So the carrying amount of the investment in associate was therefore 8850. The question has told you that. Even if not told, you could have calculated it. Okay, on 1st April 12, that is the very next day, PQR acquired the remaining 70% of XYZ for cash of 25,000. This is PC, let us say, for the remaining 70% stake. Okay, the following additional information is relevant as on that date. The fair value of the 30% stake is now 9,000. Your existing stake was at 8850. It has to be remeasured, taken up to 9,000. So there's a 150 additional gain which will be taken to PNL. So for this, probably your entry will be investment account debit 150 to, let us say, again on remeasurement 150, which will go in the PNL. So now your investment comes to 9,000, and fair value of XYZ's net assets are 30,000. This is net assets taken over. How should the business combination be accounted for? So you will first remeasure the investment and then you will take over the net assets. On 1st of April 2012, net assets of XYZ, account debit 30,000. For this, you will pay consideration to bank for a 70% stake. You will have a payment of 25,000. But is that it? Well, no. You will also have an investment. Sure, investment over here will be eliminated, but the investment will now appear at 9,000. Remember, you must have passed an entry earlier for the purpose of remeasuring investment. Institute passes one single big entry. We divide this into 2 or 3 different entries, and hence there would be a separate goodwill which will come, which will be, I think, 4,000. Now, usually one could say that your answer should end over here. However, remember, when you recorded this investment, you credited the consolidated profit and loss by 700, consolidated FCTR by 100, and consolidated retained earnings by 50. Now, this FCTR and revaluation reserve was pertaining to investment. Now, for whatever reason, the investment is derecognized, and hence, what will you do with the balance in the OCI? Well, it has to be transferred either to the retained earnings if it is non-reclassifiable like revaluation, or to the statement of P&L if it is reclassifiable like FCTR, and hence there would be a hidden entry where you would say consolidated FCTR account debit, which is a reclassifiable OCI, and hence it will be taken to the profit and loss account, which is 100, and then there will be consolidated revaluation account debit, which will be debited by 50, and to retained earnings, consolidated retained earnings will be taken at 50 rupees. So their institute has combined all of these 4 and passed as a single entry. You can also do that, or preferably pass 4 separate entries, which will give you the same ultimate effect. So that is another interesting question. We have just discussed that over here, and it's also part of a RTP May 24 question. So this kind of takes care of the core business combination part of the chapter. After that, there are 3 special cases that you need to know: the general common control combination, special workings for demergers, and then reverse acquisitions. So let us proceed further. Let us first discuss about what is a common control combination. A common control combination, also popularly called as a CCC, is a transaction where the entities which are combining were previously controlled by the same individual or single shareholder, or jointly controlled by the same group of shareholders. So over here, if the entities which are joining or combining were earlier owned or controlled by the same shareholder or jointly controlled by the same group of shareholders, then the transaction between the two is treated as a CCC, a common control combination, which will be accounted for using a pooling of interest method, which is a slightly different method than the acquisition method. So what are the features of a common control combination? One needs to remember that the entity has to be previously controlled. Let's say there are fellow subsidiaries. The fellow subsidiaries are previously controlled by the same party. So if fellow subsidiaries decide to merge, it cannot be said that one of the subsidiaries is actually obtaining control in essence over another subsidiary, because as a matter of fact, both of them were even previously and even after the transaction controlled by the same ultimate party. And hence, when we look at a common control combination, like in the Duck Swan example, Duck and Swan were not controlled by the same shareholders. Maybe Duck was controlled by Mr. D, maybe Swan was controlled by Mr. S. So when Swan acquires Duck, it is actually acquiring control over a separate business and not a common control combination. It is actually a business combination. However, in case both of them were obtained by, both of them were controlled by the same party, let us say Pigeon, then we could have said that Duck and Swan are controlled by the same parties, and hence what is happening is it is just joining or pooling of interest or a restructuring which is happening, and not really an acquisition which is happening. So over here, what does common control combination means? It means acquisition of entities or businesses where combining entities or businesses are ultimately controlled or jointly controlled by the same parties or parties both before and after the combination. So this is the essence. The only exception over here is if the common control was transitory. Transitory means a very short period. So maybe the stake was commonly controlled by a particular shareholder only for a few days, in which case we say it is transitory, in which case the guidance on common control combination does not apply. In other cases, we will apply the guidance on common control. Examples of common control combinations can include merger of fellow subsidiaries, or merger of a subsidiary with a parent, etc., or a conversion of a partnership firm into a company, or certain cases of demerger as well. Now, for you to figure out whether there is a common control combination, you need to be clear that the parties controlling pre and post the combination should be the same. They can be controlling or they can be jointly controlling pre-combination, and those same parties have to either control or jointly control post-combination. For you to have a common control combination, there has to be common control in the first place. If there is a setup where entity A and entity B are joining, entity A is having thousands of shareholders, none of them controlling. Entity B is also having thousands of shareholders, none of them controlling. If A were to acquire B or vice versa, we cannot say it is a common control combination because A is under no one's control or no one's joint control. B is also under no one's control or no one's joint control. So for there to be a common control combination, there has to be control in the first place. If there's no control, there's no question of a common control. So over here, that is one of the points that you need to remember. Is in case there is a common control combination and you were to prepare financial statements, we can retrospectively restate from the date the common control originally existed or the start of the year. You do not have to actually look at the date when the combination happens. For all practical purposes, you are under common control, and hence the standard allows you to retrospectively restate from the date the common control was existing. But what is the heart of this method? Why are we even identifying a common control combination? Because in such a case, we will apply what is called as a pooling, PWLING, pooling of interest method. And under the pooling of interest method, you are having 4 special characteristics. First, you will take over assets and liabilities at book values, not at fair values. You are just joining pooling of interest. It is like you had 2 flats earlier which were divided by a wall. You break the wall, you get one big flat. It is not that you are acquiring another flat. That flat was already yours. You are just joining interest. So the standard says there's no reason why you should take over assets and liabilities at fair value. You are just joining interest. So you will just joining what is there in your books. And as a result, assets and liabilities will be taken over at book values. Further, there will be no new asset or no new liability being created over here. Like you had in-process R&D, or you had I think those brands, etc. You will not create any new asset, no new liability. Whatever is there will be joined. Okay, so that is the first point. Assets and liabilities at book values and no new assets or liabilities created. Now, this is a transaction where you are taking over assets, but remember, for a valid contract, there should also be consideration. So this consideration, like assets are at book value, so consideration should also be at book value. Usually the consideration that you pay PC is at fair value, but usually the assets that you take over is also at fair value. Here, the consideration that you pay will be at your agreed value. Agreed value over here will be, even if given the agreed issue price, and if not given, it will be the face value. Again, the fair value is irrelevant. So securities issued as a part of consideration should be recorded at nominal value, which is issue price if given, and if not, then the face value. So this is your transaction. You take over assets and liabilities at book values and you issue consideration, maybe shares, etc., also at book value. Okay, what about reserves? So reserves, so you don't take over. Under the acquisition method, you don't take over. However, under a common control combination, in case the selling company closes, then you are allowed, or rather required, to take over the reserves. Remember, if the selling company does not close, you should not be taking over reserves, because that will result in a selective transfer of reserves, and hence in most of the demerger problems, the institute does not take over the reserve of a particular division because the selling company is still continuing. However, if it is an amalgamation where there is a company AX, there is a company BX, both of these companies are closing and a new company is formed, if there was a common control combination, you are required, or rather allowed, to take over the reserves of each of these companies. So this is a feature of a triple C. Ideally, reserves are not transferable. However, because it is a restructuring, we were saying that these earlier reserves were also earlier earned by you as a group, and hence as a special privilege, the standard allows you to take over the reserves. So all reserves or retained earnings would be taken over, and the identity of the reserves will be maintained. Reserves will be taken over in case the selling company closes. Obviously, if the selling company continues, then the reserves will not be taken over, like in case of demerger. And the last, if there is a difference, see, you will take over asset, you will take over liability, you will also take over reserve if applicable. And if there is a difference, usually the difference, that is a balancing figure, if it arises on the debit side, we call it as goodwill. If it arises on the credit side, we can call it as gain on bargain purchase. But you can't have a goodwill by buying your own business. You can pay for goodwill premium for someone else's business, and hence the standard says the balancing figure here cannot go to goodwill. Similarly, gain on bargain purchase, you can't bargain in front of the mirror with your own self and say that, okay, this is a gain on bargain purchase. No, bargaining has to happen with outsiders. This is more of a restructuring, and hence the balancing figure, if applicable, either on the debit side or on the credit side, will neither go to goodwill nor will it go to gain on bargain purchase. Instead, it will be going to the capital reserve. Again, it is a special transaction, not a day-to-day transaction, and hence it goes to capital reserve. in the form of gains or losses, let us say on restructuring. So over here you will have, if there's a difference between PC and net assets including reserves, then the difference whether positive or negative. A lot of times people say, sir, how can there be a debit balance in the capital reserve? Why not? Do you have a debit balance in P&L? Yes, that is revenue losses. In a similar way, debit balance in the capital reserve is like capital losses. Why not? So over here there can be a separate line item, that is capital reserve. Goodwill or gain on bargain purchase cannot be created. So these are the essential features of the pooling of interest method. Next you have demerger. So when you look at demerger, which is a special case over here, what happens in case of a demerger? Well, in case of a demerger, there is a company which might have multiple divisions. It separates out probably one of the divisions into a new company. So it transfers the net assets into a new company. Now this is a selling company, but the new company is a purchasing company. So the new company will take over the net assets, and in return it has to give some consideration. So the question arises, to whom does it give the consideration? Well, it can give the consideration to the selling company directly, or it can give it to the shareholders of the selling company. Accordingly, your accounting will change. Remember, demerger is done for various reasons, like you want to separate out loss-making entities, or you want to enhance management focus, or you want to unlock value. Whatever be the reason, we are doing accounting, and under accounting we will say that how do you account for a demerger? In the books, let us say, of the selling company, in the books of the purchasing company, there are three distinctive cases. First, where X has two divisions, let's say D1 and D2, it transfers division D2 to a company Y. Y issues shares in consideration of that to the person who is transferring, that is X Limited. Now, if Y is issuing shares to X Limited, post the transaction, you will see that in this case, post the transaction, X will hold 100% stake in Y. So the division D2, which was earlier controlled by X directly, is now transferred to Y Limited. But if Y Limited is issuing shares to X Limited only, Y Limited will act as a wholly owned subsidiary of X, and hence we can say that the business of D2, which was previously controlled by X, is still controlled by X only. Now, who is the shareholder of X? We don't care, because X is a separate legal entity, and X was earlier controlling D2, is now also post the transaction controlling D2, in which case it becomes a common control combination. So this will be treated as a triple C. A triple C in the books of Y Limited. So Y will take over assets and liabilities at book values. So if I were to pass entries, and we will study that in the future in some time, if I were to pass entries in the books of the acquirer, if it is a common control combination, Y would take over assets and liabilities at book value. So assets account debit, liabilities will be credit, shares will be issued, and the balancing figure, if any, will be the capital reserve. Will you take over the reserves? Answer is no, because X still continues, so reserves are not taken over. Similarly, in the books of the selling company, X Limited, will you also pass entries? Yes. Well, S is de-recognizing the assets, so it will credit the assets. It will debit the liabilities. Will it remove the reserves? No. But in return, is X getting something? Well, yes, it is getting shares in Y. So over here, in the books of the selling company, under option 1, we will say liabilities removed at book values, assets also removed at book values. Investment created, because that is what they are getting, and the balancing figure will still go to capital reserve because it is a special transaction. The second case is where PC is paid to the members. If it is paid to the members, X is transferring D2 to Y. Y issues PC to the members. If it is issued to the members, we need to see if there is any controlling member or no. So let us say there is A Limited who holds a 90% stake in X Limited. That same A Limited is also going to own a 90% stake in Y Limited. So if Y issues PC to the members, then Y is not a subsidiary of X Limited. However, Y is issuing shares to the members. There's a controlling member A who controls X. There's that same controlling member A who also controls Y, and hence the business of D2, which was earlier controlled by X and thereby ultimately controlled by A, is now controlled by Y and then ultimately still controlled by A, and hence the business of D2 is still under common control. And if it is under common control, in the second case where PC is issued to the members and there is a controlling member, this will also be a triple C, whereby in the books of the acquirer, you will still take over assets and liabilities at book values. You will still not take over the reserves. You will still issue the consideration at the book value, and balancing figure will be goodwill. Balancing figure will be capital reserve, gain or loss on restructuring. In the books of the selling company, what will happen is, in this case, still everything will remain the same. You will derecognize the liabilities. You will derecognize the assets, but here you will not get this investment. Like if this investment was obtained in case 1, that investment will not be obtained. So you have to remember that you will not get the investment or shares in Y, because they will be given to your members and your members are different from you. So that is the only point of difference. And then is the last case where it's the same case. There is X, it transfers division D2 to Y. However, there is no controlling shareholder in X. there are 100 shareholders, let us say, holding 1% stake, then those same 100 shareholders might be holding 1% stake in Y. So post combination, the business of D2 is now controlled by Y. Y is not controlled by anyone. Business of D2 was earlier controlled by X. X was not controlled ultimately by anyone, and hence the business of D2, which was earlier controlled by X, is now controlled by Y, and hence this is an actual business combination. And if it is a business combination, then assets and liabilities will be taken over at fair value, and PC will also be issued, let us say, at fair value. So over here you will have assets and liabilities taken over at fair value. PC shares issued will also be at fair value, and balancing figure, if any, will be towards goodwill or a gain on bargain purchase, as the case may be. Now, in the books of the selling company, there's a slightly complicated working that happens over here. Other than this, the workings are fairly logical. Institute has removed the workings in one of the sums which it had earlier, long time back, but we are just solving based on the overall understanding what happens in case of option 3. Well, remember, there is a separate guidance when you study Ind AS 10. There's an appendix to Ind AS 10 which says distribution of non-cash assets to the owners. Like if the company had cars and it was distributing cars to the owners, this is distribution of non-cash assets to the owners. Your entry will be something account debit to cars. First of all, what will you debit? Will you debit loss? No, this is not a loss. This is not scrapping. This is giving to the owner. So it is like a distribution. You may or may not call it as dividend, but it is definitely a distribution to the owners, which will be adjusted against retained earnings. So distribution account debit to cars. But again, these cars may have a book value of 100, fair value of 400. So what you are actually distributing is worth 400, and hence the law says you will first have to remeasure these assets being distributed at fair value and then take it as a distribution. In this case, there is a division D2. Division D2 is transferred to Y. Y should ideally give shares to X, and X, rather than retaining those shares, is distributing it to its owners. So this is also a distribution of shares to the owners on non-cash assets, represented by division D2's assets to the owners, and hence the appendix to Ind AS 10, the guidance actually applies. And under that guidance, what will you do? You will remeasure the assets, you will remeasure the liabilities at fair value, take the difference to the profit and loss account if nothing else is given, and then derecognize those. Once you derecognize it, the balancing figure typically goes in as a capital reserve. However, here this is a distribution of non-cash assets to the owners, in which case it will go to a distribution which is a part of retained earnings. So if I go to the selling company's books, what happens in this case is you will remeasure. Transaction gets covered as distribution of non-cash assets to owners. A student can always argue that, sir, even in option 2, when there was a common control combination, you were issuing shares to the shareholders A and B, that is also a distribution to the owners. However, the appendix to Ind AS 10 has a scope exclusion. It says that we will not cover under this guidance common control combinations, and hence in case 2 we don't treat it as a distribution, but in case 3 we do treat it as a distribution. So over here this is a little complicated, but institute has never asked you sum on this. So this is fair value and the difference is taken to P&L, and then assets and liabilities would be eliminated at fair values, and the balancing figure taken to a distribution or dividend, which is a part of retained earnings. So over here this balancing figure is going to go as a distribution. So this is something where you will probably need a little more practice if you want to understand it at depth. So these are the 3 methods. So whenever you see a demerger question, ask yourself whether it is going in case 1, case 2, case 3. Case 1 is when the PC is issued to the company directly, selling company, in which case the new company is a wholly owned subsidiary, it will be a CCC. In the second case, PC is given to the members, but there is a controlling member, and hence ultimately the control still continues to remain with that controlling member, and hence it is still a CCC. But in the third case, there is no controlling member, PC is given to the members, and hence for the acquirer it is actually acquisition of a business, and we cannot say that there is a common control, because ultimately X was not controlled by anyone, Y is also not ultimately controlled by anyone. Okay, so based on this, there is this detailing or example regarding this appendix as well. You can try a particular question. I think we have kept a demerger question which was asked in the exam earlier. Question number 1. So let us review this question number 1. Enterprise Limited has 2 divisions, that is a laptop division and a mobile division. Laptop division has been making constant profits, whereas a mobile division has been invariably suffering losses. Okay, so there are 2 divisions in this company, Enterprise Limited. On 31st March 12, the division wise extract of the balance sheet was given to you. Okay, division mobiles. Okay, so this is the division that we are talking about. Along with its assets and liabilities, was sold for 25 crores to turn around a new company who allotted 1 crore equity shares of rupees 10 each at a premium of 15. So your issue price is 25. to the members of enterprise. Very important. First you have to ask yourself, okay, bhai, theek hai, you are demerging, removing your mobiles division, giving it to turnaround. Turnaround is giving PC to whom? It is giving PC to the members. So it's definitely not case 1. PC is going to members. Then you search if there's a controlling member or not. In full settlement of the consideration in proportion to the shareholding, one of the members of enterprise was holding 52% of the company, which means there is a controlling member, and hence in enterprise is controlled by that shareholder holding 52% stake. Turnaround will also be controlled by that shareholder holding a 52% stake, and hence this can be taken as a case 2, which is a common control combination. Achha, what if it was told that none of the members was holding more than 50% stake, in which case it will be a case 3, which can be treated as a business combination. But what if the question remains silent? If the question remains silent, we have to make an assumption, and for making assumption we can look at various data in the question to figure out whether the assets and liabilities are taken over at balance sheet values or what values, to clearly figure out what assumption is the most reasonable. In this case, none of those assumptions are required. It is a common control combination. Assuming that there is no other transaction, you are asked to pass entries in the books of enterprise. Who is enterprise? A selling company. Selling company will de-recognize assets and liabilities pertaining to the mobile division, prepare balance sheet of enterprise after the acquisition entries, and then the balance sheet of turnaround. So first of all, if I were to pass entries in the books of enterprise, so this is a selling company. For selling company, I will de-recognize the assets and liabilities. So your liabilities over here would include, for example, loan funds of 300, current liabilities of 400. These are having credit balances. Apart from that, a provision for depreciation of 400 can also be treated to be a credit balance, and hence this will be de-recognized. But will I also remove the reserves? The answer is no. Remember, this will result in selectively transferring reserves, and hence otherwise you can transfer reserves selectively and create a distributor profit, etc. And hence this, in line with institute solutions, we will not transfer it. So over here, if I were to transfer the liabilities, this is what? Provision for depreciation account debit 400, then current liabilities account debit, I think 400, and loan funds account debit. This will be debited at 300. So this is de-recognizing the liabilities. You will also de-recognize the asset like the PPE. You will de-recognize the asset like the current asset. So over here 500 of PP and 500 of current assets. Both of these are de-recognized. So over here this will be, let us say 500. This will be 500. Will you de-recognize the reserves? No. And hence if there is a balancing figure over here, we will say that, well, this is 1100 and let's say this is 100, and this will be called as capital reserve. This will be called as gain on restructuring. As you can see over here, you will say that this is a balancing figure of capital reserve gain on restructuring worth 100 rupees. Now based on that, if you have to construct the balance sheet, you will have to do it in schedule 3 format. So you will start at your PP. Your PP will appear, well, it was 125 minus 100, so this will be at 25. Apart from that, you will have a current asset 700 minus 500, so this will be at 200. Current liabilities will be shown separately in the liabilities section. In your share capital, you will still have a share capital of 25 crores. When you go to your reserves will be 75 total, but to that 75 you will add 100 rupees of capital reserve, and hence your balance sheet will have 175 worth of capital reserve. Loans have been removed, 0 loans, and your current liabilities will be 425 minus 400, that is 25. So if I look at the enterprise balance sheet, 25 of PP, 200 of current assets, 25 of share capital, no changes, 75 of total reserves plus 100 of capital reserve, and hence 175, and then 25 of current liabilities. Achha, next, when you go to turnaround, what is a journal entry in the books of turnaround? Well, if enterprise is giving up everything, turnaround will be receiving that. So turnaround will take over PP. But remember, PP we will not take over at 500 cost, 400 accumulated depreciation. No. We will say at the end of the day, it's a new company. A new company cannot technically have an accumulated depreciation. So you will take over the PP net, but at what value? Sir, we will take it over at book values. Why? It is a common control combination, and hence 500 minus 400, that is equal to 100. PP debit. Then you have current assets debit. How much are you debiting the current assets by? I think 500 rupees. 2, you will credit the current liabilities. You will credit the loan. I think current liabilities at 400, loans at 300, and you will issue shares. Equity share capital 1 crore shares of rupees 10 each, that is 10. At a premium of 15, agreed price, so that is 1 into 15, that is 15. And hence if I go to see, there will be a balancing figure on, I think, the debit side. So this is 700 plus 25 minus 600, and I think there is a 125 debit balance. Can I call this as goodwill? The answer is no. Why? Because this is a common control combination, and hence this will go as capital reserve debit balance. Now if I have to prepare turnaround balance sheet, it is nothing but these items. So if I go to say for turnaround, your PP will appear at 100, then current assets will appear at 500, that is it. 600 will be the total assets. Your share capital will appear at 10 in the equity section, and your reserves will appear at 15 credit and 125 debit, and hence it's a negative 110. So over here, if you go to see, there's a negative 110 on your reserves. Loan funds will be taken over at 300, current liabilities at 400, and hence your total of the balance sheet comes at 600. You will also write a note to explain to the examiner the possibility that there is a restructuring which is happening, so a note can possibly be given. So this is a typical demerger question, a typical demerger adjustment. So that takes care of demerger along with the question. And the last part over here can involve a reverse acquisition, where there is a reverse acquisition in a holding company, subsidiary company setup, and then there can be a reverse acquisition which can be considered even in an amalgamation setup. So there are two questions which in our books were 71 and 73. 71 is a tricky one, but it has never been asked. 73, or a question on similar lines, has also been asked. So we will review that. So a lot of this theory is there, but we'll probably review and do the workings for both of these questions independently. So we will first do, I think we will go to question number 2, which is similar to 71. Now for this we have a separate video altogether on reverse acquisition for this question on YouTube. If you want to do it in detail, might as well you should refer that video. So this is question number 2, where there's a reverse acquisition which is happening in the holding subsidiary setup. And there is question 3, which in my opinion is slightly more important. We have included this question 2 in the important questions because this is the only tricky one which has not yet been asked in the past in the exam. And then there is a question 3. I would say that this has been asked, and from an exam perspective this is relatively more important. So I'll first do question number 3, finish that off, and then probably go to question number 2, which is a little more taxing. And in any case, there's a separate video for that. So in case you have already referred that, then you can probably get done with your revision. So let us go to question number 3, please. So let us review this question. There is a company AX and BX amalgamated to form from 1st January 13 a new company ABX. So basically let's call them as A and B coming together to form a new company AB. So this is an amalgamation type of a question. Was formed to take over the business of the existing company. Summarized balance sheets are given below. So you have a detailed balance sheet given. ABX issues the requisite number. Now this is kind of a problematic statement because of which you will have to make certain adjustments, at least in the second part. ABC issues the requisite number of shares to discharge the claims of the equity shareholders of the transferor companies. Requisite, it does not really tell you how many shares. Usually in every other question apart from this, you have been told how many shares are to be issued, and hence PC is based on the net payments method, as you call it, how much are we going to pay. However, in this particular case, they don't tell you how many shares are to be issued. They say requisite number of shares are to be issued. Okay, prepare a note showing the purchase consideration, first part, second discharge thereof, and draft the balance sheet. So 3 things of AB, assuming that both entities are under common control. So this is an easier version, I would say. The question very clearly tells you that both of them are under common control, and as a result you need to apply what you call as a pooling of interest method, joining or pooling of interest method to be applied. However, for you to apply that, you need to find the PC. See, the net assets under the pooling of interest method, we know net assets will be taken over at book values. So you have all the assets, all the liabilities which will be taken over at book values. However, PC, we don't have the PC. So how will you calculate the PC? Well, we will assume that whatever is taken over, corresponding to that, we will issue, let us say, the requisite number of shares. So that will be PC. So this is the first part. I would say this is a slightly more manageable part. Second, assuming BX is a larger entity and their management will take control over the entity. So the question over here in a soft way clearly tells you that BX, in the second part, a completely independent part, BX is a larger entity, and over here this BX will take control of the entity. So if this BX is actually taking control of the entity, then we say that it seems that BX is acquiring control over ABX, but actually ABX is acquiring BX. So maybe there will be some adjustments here. The fair value of net assets of AX and BX are given below. So you have the fair value of fixed assets, inventories, as well as the fair value of the entire business, like the market cap. Now, if you go to part A says that we have to solve using a common control combination. In common control combination, is the fair value of the individual assets, or even is the fair value of the entire business, is that relevant? No. Everything will be taken based on the book value, and as a result you will try to find, let us say for a common control combination, you will try to find your PC, So requisite PC will be your total assets at book value. Sir, fair value is given. We will ignore that. We will take that at book values. And then you will subtract the liabilities. Liabilities over here would be the borrowings and trade payables. So basically your net assets before adjusting any reserves. Before reserves adjustment, if you look at your net assets, this will be what? 13,050 minus, let us say, 4,000. So this is, I think, 9,050, and in the second case 15,200 minus, I think, 5,500. This is 9,700. But in a common control combination, are reserves also taken over? Well, yes. And hence over here, if you go to see the reserves over here, you can also have separate breakup for the reserves, but let us say for simplicity, the reserves as it is. Now net assets has a debit balance or a credit balance? Sir, it has a debit balance, but reserves have a credit balance, and hence what you will take over is another 3,050 worth of reserves. You will take over another 2,700 worth of reserves, and hence your net assets after considering reserves. So if you look at your net assets after considering the reserves, your net assets would be probably 6,000. The net assets would be probably 7,000, which means the total PC that you have to pay is going to be 13,000. Now this PC, the question says determine a note showing the purchase consideration. The institute also rightly says that the purchase consideration, it is in the first part, will be 13,000 to be paid for A and B combined, but then the discharge thereof. Now how will you discharge? To whom will you discharge? Well, a student naturally answers that, okay, if nothing is available, 6,000 will be given to the shareholders of A and 7,000 will be given to the shareholders of B. But that is honestly not a fair discharge. Institute has also not taken that, primarily because it is very much possible that over here A is running a bigger business, B is running a smaller business. However, when you, so let us say A and B both have assets of 1,000. A has a loan of 900 and a share capital of 100. B has a share capital of 100 but P&L balance of 900. So if I go to C, if I take over assets of 1,000 minus loans minus P&L, net at both places it is 100 only. However, one can say that, well, the company with the P&L balance is a much bigger company as compared to the company with the loan balance, and hence ideally if you have to discharge the PC fairly, you will discharge it in the ratio of the net assets before adjusting reserves. So definitely PC will be 13,000, but this 13,000 will be attributable to the shareholders of AX and BX in the ratio of, so this is 13,000 into, let's say, 9,050 upon 18,750, and for BX it will be 13,000 into 9,750 upon 18,750. So if you go to C, this will be, I think, 6,275 and 6,725. So this is, I think, 6,275 and this is 6,725. So this is your discharge of PC. So if I go to C for common control, we say that, okay, the PC is 13,000 and discharge thereof is 6,275 and 6,725, and draft the balance sheet. So over here I think this is 6,275 and this is 6,725. Draft the balance sheet as well. So for balance sheet you will take over assets and liabilities but at book value. So you will prepare it in the name of ABX and take over assets and liabilities at book values, and then separately you will have you will also take over the reserves and you will issue in total 1,300 shares of rupees 10 issue, that is 13,000. But the question is, will there be any goodwill? Well, it can't be because there's a common control combination, no gain on bargain purchase. But will there also be a capital reserve? The answer is no. You can do the workings, but what happens is, what you are taking over, exactly that much are you issuing as consideration, and as a result there would be no difference overall, and hence there is no separate capital reserve. All you have to do is, you have to just take the totals over here. This is probably 16,000 for PP, this is 1,600 for the investments, inventory is around 4,000, trade receivables 5,800, and this is 850. Share capital will be 1,300 shares of rupees 10 each, so this is 13,000, and other equity will be, I think the total of both of these, this is what, 5,750. Your borrowings will be 7,000 and your trade payables will be, I think, 4,500. If you take this, ideally your balance sheet will tally, if you do the workings properly, there is nothing else. So this will tally at 28,250. I think a similar working can be given in the printed solution. So if you refer, this will give you your balance sheet at 28,250. Okay, so that is part A. Now part B honestly can be solved in one of the two ways. we will solve it and discuss it the way the institute has done it, and then you do a slightly more simpler discussion as well. So what is happening over here is BX is given to be a larger entity, and the management of BX is supposed to take control of the entity. So this clearly appears that when there are two transactions, that is AX merging with ABX, BX merging with ABX, when BX merges with ABX, BX ultimately takes control over ABX, and hence from an accounting standpoint, BX is the accounting acquirer. Though from a legal standpoint, it might appear that ABX is the legal acquirer. So the institute has treated, solved and explained for this, considering this to be a reverse acquisition. And if it is a reverse acquisition, then you will prepare this in the name of the legal parent, that is ABX. However, it will represent continuing financial statements of BX, and hence the assets and liabilities of BX will continue at the same book values. Reserves of BX will continue as it is. This is how the institute has solved. You can refer that. They treat it as a reverse acquisition. That is the explanation even that we have tried to explain. You will prepare it in the name of ABX. You will take over all assets of BX because it is continuing financial statements of BX. So BX assets and liabilities will be at their book values. There will be no fair value adjustment for BX because BX ka control is not shifting. And reserves of BX will also continue. If nothing is given, we will assume that the consideration that is to be paid to BX for this transaction will be the same as its share capital, which is 700 shares of rupees 10 each, that is 7,000. Like we did even in this method, we found this as 7,000, institute has taken that. And then the transaction with AX, well, AX over here, the business of AX was controlled, let us say, by someone. Post the combination, it will be controlled by ABX, and hence there is a transfer of control, and hence we will take over assets and liabilities of AX at fair value. So these individual assets and liabilities of AX will be taken over at fair values. But then when you are issuing consideration, when you are paying the PC, that PC will also be based on the fair value of business. So over here, AXK assets and liabilities you take over at fair value, and because it is an independent transaction, not a common control combination, we will have to pay the entire 11,000 for AX business. So if I go to see the PC over here will be 11,000 rupees. This will be PC, but how is this PC discharged? Unfortunately, it is given that it is discharged by issuing a requisite number of shares. I have not told you how many shares, so which means we will have to find the number of shares to be issued. So the institute over here, in my opinion, rightly so, has tried to find the issue price of the shares. They have said that, okay, well, you know what, when I go to AX and say that I need your business, AX says I need 11,000 rupees. We try to pay 11,000 rupees through our own shares, but our own shares of ABX should have a face value of 10. However, ABX houses the business of BX. BX ka business has a fair value of 14,000, and against that, currently the number of shares are 700. So the value for each share, for example, is 20 rupees. So when AX says that, well, you know what, you need to pay me 11,000, when we issue the shares, AX might say, okay, you give me 11,000 divided by 10, that is 1100 shares. We will say no. If you are demanding 11,000 because it is a fair value of your business, the shares that I am issuing are also worth 20 rupees. These shares are holding a business worth 14,000. These 700 shares were holding a business of 7,000. So each share is worth 20 rupees, and hence the number of shares that will be issued to the shareholders of AX are going to be 11,000 divided by 20, that is equal to 550 shares. So over here, when you look at BX, you take over assets and liabilities of BX in a way legally at their book values, and you issue the shares also at book value or face value. But when you go to AX, you will take over the assets and liabilities at fair values, and the shares that you will issue will also be at the fair value, that is equal to 20 rupees. Now this is how the institute has solved, and hence we will also solve it accordingly. So there will be two transactions. One is a transaction between AX and ABX, where you will take over assets and liabilities of AX at the fair value, pay a PC of 11,000, create a goodwill if any. And second is a transaction with ABX and BX, where we treat it as a reverse acquisition, where you have BX continuing financial statements. So BX and assets and liabilities will be at the book values. The statements of BX will continue, and hence this transaction in a way is treated by the institute as BX acquiring AX through ABX. Okay. An alternative way, in my opinion, which you could have also done, which would have given you the same answer, is AX and ABX in a same way. But we can say that in a simplistic way, BX and ABX are under the same control. Both of them are controlled by BX or whoever is the controlling shareholder in BX. And as a result, if you treat it as a common control combination, still assets and liabilities of BX are going to be taken over at book values. Still, reserves of BX will be taken over, and it would have been a fairly easy thing. But I've given this as an alternative note, but I would not recommend writing that in your solution because the institute's solution is based on reverse acquisition. So over here, what will happen is when you look at AX, if you look at question number whatever that is, part B, if you look at AX, I will take over assets and liabilities of AX at fair value. So that is 9,500 will be the fair value of assets. Will be, instead of inventory is there, so instead of inventory of 1250, this will be 1300. BX will continue to be at their respective values only. So over here everything else remains the same. So this is basically the same 1050, this is same 1800, 450. Will the share capital of AX be taken over? No. Will the reserves of AX be taken over? No. But will the liabilities be taken over? Well, yes. This will be 3000. This will be 1000. Now, against this, will you have to issue shares? Well, over here, we will issue 550 shares of rupees 10 each of ABX. And as a result, to the 7000 worth of share capital, which will be issued by ABX to the shareholders of BX, we will have another, I think, 5500. Separately, when you look at other equity, to the other equity of 2700, you will also add the securities premium. There will be a securities premium. In this question, the institute has taken. Students do sometimes ask that in other questions they might not have taken for reverse acquisition. In this question, they have taken. So we currently solve and take this. So this is 550 into 20 minus 10, and hence this is another 5500. This will be a part of the securities premium. Once you take this, other than that, you will have the assets and liabilities of BX as it is, but there would be a goodwill as well. So over here, we will say that, okay, we are paying a PC of 11,000 for acquiring net assets of AX. So if I look at this working over here, when you have the net assets of AX, all of these. So if this is for AX, net assets taken over, 10,100, this is at fair value. As you can see over here, these are fair values. Otherwise, the book value and fair value is the same. And hence, the difference over here of 900 comes as a part of goodwill. So over here, you will recognize the goodwill to the extent of 900. The moment you have done that, other than that, you will have 7,500 plus 9,500, which will come to, let us say, 17,000 in my ABX balance sheet ultimately. Then you will have 1050 and 550. This is 1600. Inventories will be, I think, 4050. This is 5800. This is 850. Share capital, probably if you total up, this is 12,500. Reserves, if you total up, this is what, 2700. Existing reserves of B plus 5500. So this is 8200. These loans will be 7,000 over here and will be 2,500 over here. And if all goes well, and if you were to total, this is what, 17,900, 1600, 4050, 5,800 and 850. This comes to, I think, 30,200, and this number tallies. So over here, this will give you 30,200. Where is this? 30,200. Now the institute actually, so this is how you would have solved, but the institute actually tries to even prove that how can we prove that this is a reverse acquisition. So over here they say that in ABX you had 700 shares which are held by the shareholders of BX, another 550 shares which are issued to the shareholders of AX, and hence there is a total of 1250 shares. Out of these 1250 shares, to the shareholders of AX you have 550 on the base of 1250, so that is around a 44% or so stake. Just a second, 550 upon 1250, 44, and then the shareholders of BX would have 700 out of 1250, which is equal to a 56% stake. And as we expected, BX shareholders have a controlling interest, that is 56% in ABX, and hence the institute treats this as a reverse acquisition case where BX is acquiring control over ABX. Sorry, it is BX is acquiring control over AX, let us say through ABX, and as a result over here, BX, you keep everything at its book values including its reserves, and for ABX you take over everything at fair values, and the shares that you are issuing also will be at the fair value. Now, usually in this particular case, if that requisite number was not given and they had told you exactly kitne shares are issued at what price, it would have been a little more easier in my opinion and a little less contentious. However, if it comes in the exam, I do believe it will come in the same form, and hence just ensure that you practice this question fairly well. So that is question number 3. And there is another question which is a question number 2, which is kind of a very tedious question of reverse acquisition. We have a separate YouTube video for this, so you can refer that separately. But otherwise, if we were to quickly discuss this so that it kind of cools your nerves, because this question is something where students do face a little bit of problem. So we'll just quickly discuss this. Okay, so this is question number 2 now. On 30th September 11, entity A issues 2.5 shares for each ordinary shares of entity B. So this is apparently A paying to the shareholders of B. So A seems to be the acquirer. All of B shareholders exchange their shares in B. Therefore, A issues 150 ordinary shares in exchange for all 60 ordinary shares of B. So 60 shares of B. Each share of B is worth 2.5 shares of A as seen in the first line, and hence you are issuing 150 shares. Okay. The fair value of each ordinary share of B on 30th September is 40 and the quoted market price of A is 16. Quoted market price, if you apply Ind AS 113 over here, quoted market price is a level 1 category input. The fair values of entity A's identifiable assets and liabilities on 30th September are the same as their carrying values, except that the fair value of A's non-current assets is 1500. So other than that, everything is the same as the fair value and carrying value. The balance sheet of A and B immediately before the business combination are, so for A you have been given the legal parent and the accounting acquiree. There is an E additionally. B is legal subsidiary and accounting acquirer. So the question has clearly told you that B over here is an acquirer from accounting purpose, and if the question tells you that B is an acquirer from accounting purpose, it is a reverse acquisition question because B is actually a legal subsidiary. So here, do I need to test for reverse acquisition? If you want to, you can, but it is not required because the question very clearly identifies B as a legal subsidiary but an accounting acquirer, and A as the legal parent but the accounting subsidiary or the acquiree. I have all of this data, and then you have issued equity comprising of 100 ordinary shares of A. Total is 300, so maybe this is 100 into 3. Each share of A is probably worth 3, and 60 ordinary shares in B. So this is 60 into 10 will probably come to 600, and that is about it. Okay, there is this entire paragraph which the institute, which pertains to EPS. Institute now in its study material has removed the EPS part. We will nevertheless discuss this for our understanding. Calculate the fair value of the consideration transferred. The first step is to find the PC. Measure the goodwill 0.2 and prepare the consolidated balance sheet 0.3. Also compute the earnings per share on December 30th. Now Institute has removed the EPS part because there is a lot of confusion in any case, but if you don't want to remove it, we will kind of just briefly discuss what is to be done with EPS. Now first of all, who is the acquirer over here? It seems B is the acquirer. Why would we say B is the acquirer? Well, because in the post, as if you look at the legal structure, what is happening? If you look at the legal structure, there must be some shareholders of A holding 100 shares in A, shareholders of B holding 60 shares in B. We are acquiring 60 shares of B and in return issuing 150 shares of A to the shareholders of B. So post combination, A Limited owns 100% stake of B Limited. So B is a legal subsidiary and A is a legal parent. However, if I look at the shareholding pattern of A, 100 out of 250, that is only 40% is held by the shareholders of A, whereas 150 out of 250, which is 60%, is held by shareholders of B. And as a result over here, we can see that the control of the business of B continues to be with B's shareholders, as the control of A's business is actually shifting. So your acquirer, so this is legal form. So your acquirer over here is, it is appearing that A is acquiring B. However, it is the other way around. It is B acquiring A, and in this case the acquirer is identified as B. Now when we look at the acquisition date, there's only one date, 30th September, and when we want to find the PC, we'll say, chalo yaar, PC is a payment made to the owners. How much is a payment made to the owners? We'll say 150 shares of A is a payment made to the owners, but this is payment made to the owners of the purchasing company. B is the acquirer. PC is not defined as payment made to the owners of the purchasing company, it is defined as payment made to the owners of the selling company. That is, the payment that is going to the shareholders of A should be PC, but as a matter of fact, nothing is going to the shareholders of A. So what we try to do is, we try to prepare on an accounting base, what should this transaction appear if actually, legally, as well as for accounting purposes, B had acquired A. So had B acquired A, B would have approached A and it would have taken over all the shares of A. So there would be B, there would be shareholders of A. Now shareholders of A are currently owning 100 shares in A. Shareholders of B are currently owning 60 shares of B. If B were to acquire A, that is accounting wise, then B would have approached these shareholders and it would have acquired all of these 100 equity shares of A. But will they give this free of cost? No, they would have to be paid something. So you will give them shares of B. How many shares of B? Well, the agreed exchange ratio is 2.5:1. So which means for 100 shares of A, you should be giving 100 upon 2.5, that is equal to 40 shares of B. So you should be issuing 40 shares of B. This is one of the most easiest way. I think you could have found this 40 shares hypothetically that you had to issue. So post this, what would have happened is there would be B. B would own all the 100 shares or 100% stake in A, and then in B you will have shareholders of A who will now have 40 shares of B. This is 60 originally plus 40 new issue, and hence 100 may say 40%, and the shareholders of B would have 60%. This was your commercial understanding. Remember, whether B acquires A or A acquires B, at the end of the day, one can say with confidence that commercially both of them have agreed that in the post combination entity, B's shareholders will have a 60% stake, A shareholders will have a 40% stake. So you can alternatively also calculate and say that if B shareholders are going to ultimately have a 60% in the post combination entity, and if the post combination entity acquirer is B, then these shareholders will have 60 shares. So 60 shares is equivalent to 60%. Then 40% which is to be issued to A will be how much? Which will be 40 shares. So if I were to go to see the PC, strictly speaking, PC will be the shares issued to A. That is 40 shares issued to the shareholders of A, and each share, these are 40 shares of B, each share is worth 40, and hence PC would be 1600. Now this is one of the ways in which you can calculate PC as given in the question. Another way is we can say that, well, see, ultimately both of these are part of the same transaction. Over here on one hand you are giving 40 shares, on the other hand you are receiving 100. So PC can be either of these. Which of the two? Well, as per 113, whichever method maximizes the use of observable inputs and minimizes the use of unobservable inputs, which is let us say alternatively you can have, or you can say 100 shares of A which is acquired as a part of same transaction, which has a quoted market price of 16, and hence this is also equal to 1600. Institute has selected that they will take 1600 primarily because they say that 1600 is based on a level 1 category input, and hence you take that. So this is your PC, payment made to the owners of the selling company, that is A. But remember, all your accounting is going to happen as per these forms. This is your accounting form. So it is treated as if B is acquiring A, and if B acquires A, B pays the PC as 40 shares to the shareholders of A, which is worth, let us say in total, whichever method you select, 1600. But when B pays to the shareholders of A, B will take over the assets and liabilities of A at fair value. Remember, B's assets will continue to remain at their carrying values, B's reserves will continue. It is A's assets and liabilities which will be taken over at their fair values. So if you look at this is non-current asset, non-current liability, and current liabilities. So if I look at this working, fair value of the net assets of A is 1500 for the non-current assets. Then if you look at the current assets over here for A, this is going to be, I think, 500, and then you have non-current liabilities and current liabilities. I think this is 300 and 400 each. So this is, let us say, 300 for the current, 400 for the non-current, and hence this probably comes down to around I think 1200 or 1300. Okay, so this is 1300. Now another problem over here is people want to calculate NCI. When they calculate NCI, they actually go to the legal structure, which is wrong. Remember, the entire working is done based on this structure. Now based on this structure, if you go to see, A's assets and liabilities will be taken over by B, and B has paid PC to all the 100 shareholders of A. Now there are no other shareholders of A, and hence NCI is represented as share in A held by people other than parent, and as a result this will be 0%. Now this is, Institute has skipped this sentence altogether, but fundamentally if you were to see this, a lot of people say no, actually A has 100 plus 150, that is 250 shares, and hence there is some NCI etc. If you are taking that, your PC is not based on that. Your PC is based on the fact that you are acquiring 100 shares of A and you are paying 40 shares. Your net assets are based on the fact that you are acquiring A, and hence you can't just take for PC and net assets one method and for NCI some other method. So as per this method, B is the acquirer, You are doing accounting. B is the acquirer, A is the target, and in A there are 100 shares. All the 100 shares are issued and taken by B, and in return 40 shares are given to the shareholders of A. There is no other share issue as per the accounting structure done by A, and hence there will be no NCI, because the PC is also calculated on the same premise. So if your PC is calculated considering A has 100 shares and you are paying for that entire 100 shares and thereby getting a 100% stake, then your NCI is actually 0%. So over here, Institute has skipped NCI altogether, but if you want to consider the understanding, this is the brief understanding for NCI. If you are understanding it well and good, otherwise just proceed, because Institute has not even mentioned anything regarding NCI. So if you look at the goodwill working, this is PC, which is I think 1600 plus NCI minus net assets, and this is equal to a goodwill of 300 rupees. So basically this will give you your goodwill. So the question asks you to calculate the PC. As we said, the PC over here is going to come to around 1600, and the goodwill is the second part which is asked. So your goodwill is appearing over here at 300 rupees. So your goodwill appears at 300, and then the question says you prepare consolidated balance sheet. Now this would have been easy. This balance sheet ideally should have been in the name of B, because B is the acquirer. It represents continuing statements of B. So B's assets, B's liabilities, B's reserves will continue as it is, and to that you will take over the assets and liabilities of A. So ideally, if I were to prepare the consolidated balance sheet, it will be B's assets as it is, to which you will add A's assets. So over here, if I look at B's non-current assets of 3000, to which you will add 1500 worth of assets of A, 700 plus 500. So this will be, let us say, 3000, and so this will be I think 4500. This will be, let us say, 1200. Apart from that, there will be a goodwill which will be recorded, let us say, of 300 rupees. Acha, shareholders equity, forget that, it is continuing statements of B. So your reserves of B will continue, reserves of A will not be taken over. When you look at your liabilities, within your liabilities you will have current liabilities, I think this is 900. Non-current liabilities, let us say this is 1500. So the only section which remains over here will be the shareholders equity section. Now within shareholders equity, technically if it is in B's balance sheet, you will have 600, which is the share capital of B. Additionally, we will issue purchase consideration. Purchase consideration may be in whatever form, we will issue purchase consideration. PC over here is 1600. Strictly speaking, and we have discussed this at length separately, but to avoid more confusion and complications, strictly speaking, you will issue shares, technically 40 new shares of B at the rate of rupees 40, which means some of this will go to the share capital, some of this will go to the securities premium. Ultimately, it will go somewhere in equity. Institute does not show the breakup over here. The institute says that okay, and we will do that exactly. Institute says that okay, ultimately to the equity section 1600 will be added, maybe something to securities premium, maybe something to share capital. Can you show the breakup? Well, possible yes. Is the institute showing it? No. So will we show? No. We can directly do 600 plus 1600. Thankfully the institute is doing a slightly easier way, and hence this will come to what? 2200. So if I take the green items which are highlighted as within the liabilities section, and then the blue items which are the asset section, your balance sheet should ideally tally 1200, 4500, 300, that is 6000 on the assets, 900, 1500, 1400 and 2200, which is again 6000 on the equity. Now the thing is, you are preparing this in whose name? Someone says that we are preparing this in the name of B. No, we are preparing this in the name of A. As per the law, in a reverse acquisition, you prepare the financials in the name of the acquirer, who is the legal acquirer, but it represents continuing financial statements, that is book values, reserves of the accounting acquirer, that is B. And what is the significance of this? When we show 2200, we will show this as actually 250 equity shares of A. Now this is where things become very complicated, because actually we could have said that this is nothing but 60 plus 40, that is 100 shares of B, but as a matter of fact, B has not issued 40 shares. And hence they said that okay, let us flip it over altogether and let us prepare this in the name of the accounting acquirer, sorry, in the name of the legal acquirer, that is A, and A has 100 original shares plus another 150 shares that they have actually issued, and hence there will be 250 shares. So if you even open your institute's let us say solution. If I have this handy somewhere, just a second. What they have done is, as I've just opened this page separately, as you can see, they have prepared this consolidated balance sheet. In that, they have directly done 600 plus 1600, but they have mentioned that this is issued equity, that is 250 ordinary shares. Now, if someone were to prepare the balance sheet, then ideally we might have to create a separate reverse acquisition adjustment account, etc., which we have discussed in class. But from an exam perspective, you can directly do 600 plus 1600, that is 2200, but ensure that you show the 250 ordinary shares as your share capital. From an exam perspective, just remember that. If you go to see on the next page, the question ends over here and there is no other EPS working, etc., which has been asked. But in our question, we have actually taken the EPS working. As you see, 1, 2 and 3 things are asked in the institute material. There is the EPS working, which was all the more complicated. They have removed it, but just for completion, if you want to understand it, if we read this part of your question for the EPS calculation, we say that assume B's earnings for the period of 31st December 10 was 600. This were B's earnings. Ideally, to find the EPS, you will divide by the B's number of shares, that is 60, and hence your EPS reported in the last year must have been 10. And the consolidated earnings for the period 31st December 11 were 800. Now, in the consolidated earnings, you will have B's profits plus for 3 months, last 3 months, September to December, also A's profits. Assume there was no change in the number of ordinary shares issued by B during the annual period 31st December 10 and during 1st January 11 to the date of reverse acquisition, that is 30th. So your question has clearly told you this is reverse acquisition. Now if you want to find the EPS, ideally your EPS for the year 2010, that is the last year, and 2011, that is the current year, ideally how will you calculate this? Well, we will say in the last year there was 600 profit earned by B. You will divide it by the number of shares of B, that is 60. Similarly, the current year, the profit is 800. Now, this profit has 12 months of B's performance and only last 3 months of A's performance. So, if I were to do the working based on how the accounting structure is, we would have said 60 shares are outstanding for the entire 12 months and another 40 shares are issued to the shareholders of A, which would be outstanding for the next 3 months. Now, the problem is, if your balance sheet included 100 shares as 60 plus 40 for B, we could have done that. Your balance sheet issue includes shares of B or shares of A. Well, it is 250 shares of A, and hence under this method you are required to find the EPS based on the equivalent number of shares in A. As a matter of fact, we have 60 shares in B, but 60 shares in B are equivalent to 60 into 2.5, that is 150 shares in A. So instead of taking 60, we will take 150. 40 shares in B are equivalent to 40 into 2.5, that is equal to 100 shares in A. Similarly, in the last year, as a matter of fact, there was 60 shares of B. However, we are taking shares of A. Now, this is where student gets confused. They say, nahi sir, A ka to last time you had only 100 shares. Perfect. But those 100 shares earned profits of A. We are not comparing with the profits of A. We are comparing with the profits of B. And hence, you should take the shares of B. If you don't take the shares of B, we should take the shares which are equivalent. So, basically, last year, there were 60 shares of B, which are equivalent to 60 into 2.5. That is 150 shares of A. Highly confusing. And hence, thankfully, the institute has removed it if you see in your study material. So, this is a restated EPS of 4. And if you do the working, this is 800 by 175 and this is 4.17 or something, whatever. This is 800 divided by 175 and this is 4.57. This would be your EPS. So this kind of takes care of question number 2. So these are the 5 important questions. Other than that, if you have time and if you want to review more questions, there is a question, I think 43 as well as question number 44 in the material, which is same as this test your knowledge question number 1. If you go to see, if we had just opened, that is something that you should refer. It's a fairly easy question, I would say. This question over here, company A and B are in the power business. So if you have done more complex questions like we did question on the duck and swan, this is a much more easier version of that. So you can refer this question as well separately. Or if you have time, let us say abhi discuss kar leta. So this is 25% equity shares is held in B. Another 65% is acquired, resulting in a 90% stake. So basically 25 plus 65, so there's an existing stake. Consideration, there's a cash consideration of 59 lakhs, that is a part of PC, yes. Plus it issues shares of 1 lakh at the market price of rupees 10. So that is 1 lakh into 10, that is 10 rupees. Contingent consideration, you have to take it over at fair value. If you see the entire point, the fair value over here is given to you as 3 lakhs. So this will be 3. All of this is for the 65% stake. However, you already had an existing 25% stake, which in today's market, if you see the question properly, is worth 20. There will be a 14 lakh gain, which will be taken to the profit and loss. And hence, if I take the total PC, this will probably be around 92 rupees. Then you take the net assets. Well, net assets are given to you in the question clearly that you will take over 60 lakhs. You have transaction cost of 1 lakh, which will go to the PNL, and NCI is to be created using fair value method. So basically PC of 92 plus NCI of around 7.5 minus 60, and hence this comes to, I think, 39.5 or so, which is a full goodwill. So this is just briefly discussing this question over here. Okay, so I think that should be it. We have done a fairly detailed session. I hope this has been helpful to you. I'll see you soon with more such videos. Till then, study well, study hard, and wish you all the very best. Good luck.